Am I audible? Everyone, please let me know. Am I audible? So today our topic is foreign exchange exposure and risk management. Foreign exchange exposure and risk management. Hello Sahil, good afternoon. Am I audible? So very good. Today I will not be giving time to practice. Today I will be explaining the entire Forex. Okay. I will not be giving time to practice. Okay. And after completion of this live class, again listen to this class, and after completion of explanation of a question, pause the video and try this question. Pause the video and try each and every question. So foreign exchange exposure and risk management. Foreign exchange exposure and risk management. The weightage of this topic is 7 marks. You will get 7A and 7B and 1 MCQ. 7A, 7B and 1 MCQ. So this topic initially you might feel confused, but it is easy topic, Forex. You need not worry about Forex topic. The topic is easy. You need not worry. Please listen to the class till the end and then let me know, okay, the status of Forex in comment section. Okay. So this topic is simple topic only, Forex. But the point is, due to the time we take for preparation of Forex, I have told you this Forex as a B category topic. But whereas marks, 16 marks, you will get 16 marks from this Forex. So students who are not, okay, who cannot write theory properly, so better you prepare Forex. But suppose if you cannot retain the technical terms in digital finance or a securitization or IFM, you better prepare Forex. Students who are strong in practical questions, so you better prepare for what? Forex. Okay, that's up to you. But if students, if you are strong in theory, if you can retain theory, better what you can take Forex choice. That depends on you. Okay, completely. So foreign exchange exposure and risk management, and listen to this class. This class will be enough who have become perfect in portfolio management, derivatives and mutual funds. So security valuation and ERP. So this class will be more than enough. Okay, I will be discussing 17 questions. 17 questions. So high chances you will get 2 questions from this 17 questions itself. Okay, clear? So without wasting time, I am starting Forex, foreign exchange exposure. First, what is the meaning of a risk? A risk means a possibility of occurrence of a loss, uncertainty, deviation from the mean. For this chapter, risk means possibility of occurrence of a loss. Possibility of occurrence of a loss. Generally, firms will face 2 types of a risk. One is business risk and second is finance risk. What is business risk? Business risk depends upon the nature of a business. Uncertainty about the future operating income. Uncertainty about the future operating income. For suppose X Limited is earning EBIT, for example, 10 lakhs as on today per annum. X Limited company is earning 10 lakhs EBIT as on today, but in future it may or may not earn that same EBIT. So that may or may not is called as what? The business risk. Business risk depends upon the nature of a business. Okay. So we call it as operating risk also. And the finance risk. Finance risk means risk arising due to the usage of a debt funds. Due to the usage of a debt funds. For suppose if a business is using the debt funds, it has to face finance risk because it has to pay interest on time, principal on time, irrespective of a financial position of a business. So that type of a risk is called as a finance risk. But in this chapter, we are talking about foreign exchange risk. Foreign exchange risk. In this chapter, we are going to learn 2 parts. One is hedging. Hedging means mitigation of a risk. Second is, okay, arbitrage. Second is what? Arbitrage. So you know hedging meaning. Hedging means mitigation of a risk, and also what? Arbitrage. Arbitrator will be identifying the market, okay, imperfection, and he will always earn a profit without taking any risk. Without taking any risk. Clear up? Okay. So in this question, first you should understand the meaning of a foreign exchange risk. What is this foreign exchange risk? Okay. So let me give an example. Foreign exchange risk. Foreign exchange risk. So foreign exchange risk. Foreign exchange risk. It is an uncertainty in cash inflows or cash outflows arising due to the foreign exchange rate fluctuations. Arising due to the foreign exchange rate fluctuations. Okay. What is this foreign exchange risk? Foreign exchange risk is an uncertainty in cash inflows or cash outflows arising due to foreign exchange fluctuations. First, you should know the meaning of exchange rate. What is this exchange rate? What is this exchange rate or a foreign exchange? Exchange rate or a foreign exchange means price of one currency quoted in terms of another currency. Price of one currency quoted in terms of another currency. Okay. So, for example, so today, what is the dollar rate? $1 is equal to 88.67 Indian rupee. Okay. $1 is equal to 88.67 Indian rupee. So 88.67 Indian rupee is the dollar rate. So this is called as an exchange rate. This is called as what? Exchange rate. So tell me whether exchange rate will remain same or it keeps on fluctuating. It keeps on fluctuating. It keeps on fluctuating. Okay. So here foreign exchange risk means uncertainty in cash inflows or cash outflows arising due to the foreign exchange fluctuations. So for example, X Limited exported goods worth $1 lakh. Receivable after how many months? 3 months. We exported goods $1 lakh, which is receivable after 3 months. Receivable after 3 months. X Limited exported goods. X Limited company is in India. It exported goods to US, which is worth $1 lakh. Receivable after 3 months. What is the present exchange rate? Let us assume $1 is equal to 70. Present exchange rate. Price of one currency quoted in terms of another currency. So after 3 months, for suppose case 1, if $1 value increases to 80, what is the inflow? So 1 lakh into 80 lakhs. For suppose case 2, if $1 is equal to 60 rupees, then what is the inflow? 60 lakhs. That means after 3 months, we are not certain about the cash inflow. We do not have a certainty about a cash inflow. That uncertainty is known as what? A foreign exchange risk. Foreign exchange risk. So this foreign exchange risk arises generally if 3 conditions are satisfied. So even if in some cases 2 conditions satisfied, even if 2 conditions are satisfied, okay. So this foreign exchange risk arises. What are the conditions? Billing is done in foreign currency. Billing is done in foreign currency. Payment or receipt to be made in the future. Payment or receipt to be made in the future. And if there is a cross-border transaction, but sometimes even there is no cross-border transaction, there can be a foreign exchange risk if billing is done in foreign currency. Billing is done in foreign currency. So what is this meaning? So I will give you a simple example. For suppose if any of you wanted to write a CFA exam or CPA exam. CFA or a CPA exam, so these are Indian courses or foreign courses? Foreign courses, US courses, yes or no? US course means registration fees you have to pay in dollars. And exam fees you have to pay in dollars. Okay. ACCA course you have to pay fees in pounds. UK course, yes or no? Now tell me, for example, you have done registration as on today. You paid amount. Okay. You purchased dollars and you paid registration fee. But next 3 months or 6 months, in next 6 months, you're going to write exam. Okay. In next 6 months, you have to pay what? Exam fee. You are an Indian and you're writing a CPA exam after 6 months. Okay, that is fixed and you're going to write exam after 6 months. But after 6 months, what can happen? The dollar value might increase or dollar value might decrease. So that uncertainty is called as a foreign exchange risk. And when it arises, three conditions, even if there are two conditions, so the transaction, I mean, the foreign exchange risk will arise. What are the conditions? Billing is done in foreign currency. Yes, that condition is satisfied. We are in India. We are in India. And what? So am I audible, Sahil? My sound, is it correct or not? So the point is here, the dollar value might increase or decrease in the future. Yes or no? So conditions, billing is done in foreign currency because you are an Indian and you are paying exam fee in dollars. And next what? Payment is in future. Payment is in future. For suppose if you are making a payment immediately, then there is no risk, there is no uncertainty, because if you are making a payment present, so then there is no what? Then there is no uncertainty. Then there is no uncertainty. Okay, clear? Next, so maybe network issue, Rahul, from your side. Now, Rajesh, how are you? So clear. So foreign exchange risk is an uncertainty about cash inflows or cash outflows. Everybody clear? Are you able to understand this foreign exchange risk meaning? Clear? So here foreign exchange risk can be three types. Three. So the example which we have taken is called as a, if for example, so the example which we have discussed is an example for what? Transaction exposure. Transaction exposure. Foreign exchange risk can be what? First one, transaction exposure. Transaction exposure. Transaction exposure. The example what we have taken is a transaction exposure. Transaction exposure. Voice. Transaction exposure. Transaction exposure is a contract based. Foreign exchange risk means uncertainty in cash inflows or cash outflows arising due to the foreign exchange fluctuations. Yes or no? So first one, transaction exposure. Transaction exposure is a contract based. Transaction exposure is a contract based. Contract based means what? Transaction exposure contract based means the example we discussed. For example, we exported goods $1 lakh worth, which is receivable after 3 months. If a foreign exchange rate fluctuates, what happens? So inflows will get affected. Yes or no? So that is called as a transaction exposure. So foreign exchange risk includes a transaction risk. And next, second, operating economic exposure. Next, economic exposure. And third, operating exposure. Third, operating exposure. Economic exposure means affect overall value of a company. Affect overall value of a company. Operating exposure, it is going to affect operating cash flows. Operating cash flows. So foreign exchange risk, three: transaction exposure, economic exposure, and operating exposure. Transaction exposure is a contract based. Economic exposure is a economic exposure impact the value of a company, and contract operating exposure impact operating cash flows. So the example which we discussed is transaction exposure, because it is impacting the cash inflows of that particular contract, only that particular contract. Economic exposure means it impacts the value of a company. Operating exposure is a part of economic exposure. Operating exposure is a part of a economic exposure. Let me give an example. For suppose a company in Japan, Toyota, it is exporting cars to US. It is exporting cars to US. Okay. And if it exports the cars to US, for suppose a Japanese yen currency value has got increased. Japanese yen currency value has got increased. If a Japanese yen value has got increased, and if it is exporting goods to what? US. Okay, exporting goods to US, and Japanese yen currency has got strong. So then what happens? The receivables of a Toyota company will be decreasing. Yes or no? Because exporting goods to US, billing will be done in dollars. Billing will be done in dollars. So okay, for suppose Japanese and so let me give our Indian example. For suppose we are exporting a software to US. Okay, if you are exporting a software to US, let us assume billing is $100. Let us assume billing $100. In next 6 months, for suppose the rupee has become strong. $1 has become equal to 1 rupee. Let us assume. Okay. So then what happens? Instead of 100 into 89 rupees, you will receive only 100 into 1. Then what happens to the company which is exporting the software in India? So not just the contract value. Not just the contract value. What happens? It affects the operating cash flows, and also what it impacts the value of a company. The company value will also get reduced. If the company value is also getting affected, that risk is called as what? Economic risk. Economic risk. Likewise, if Japanese yen becomes strong, then what happens? If a dollar's receivable converted into Japanese yen, they will receive a less amount of a Japanese yen. Okay. Then what happens to the share price of a Toyota Limited? So share price of a Toyota Limited will also decrease. Am I clear? So transaction exposure, economic exposure, and operating exposure. Now come to, in this chapter we are going to learn how to reduce foreign currency risk and how to make profit out of a foreign exchange market imperfection. Foreign exchange market imperfection. Clear? Next, foreign exchange market. Foreign exchange market. It is a market in which individual firms and banks buy and sell foreign currencies. Foreign exchange market includes a spot market, forward and futures market, same like derivatives. In derivatives also we have a spot market and also what? Forward, futures and options. So without derivatives we cannot understand Forex. Foreign exchange market participants, 3 types of participants will be there: arbitrator, hedger, speculator. So we know that who is an arbitrator. Arbitrator will not be taking any risk. He will be earning a profit without taking any risk. So we are going to discuss one problem relating to the arbitrage. Hedger means a person who tries to reduce the risk, mitigate the risk. Hedger objective is not to make the profit. Hedger objective is to reduce the risk. Speculator objective is to get profit by taking a risk, but he may get profit or loss. Next, determinants of exchange rate. So theoretically, okay, interest rate differential. For suppose if interest rate decreases in a country, what happens to the currency value? Currency value will increase. So that concept we are going to discuss in interest rate parity theory. Later on we have a practical question. Interest rate parity theory. So if interest rates in a country decreases, what happens to the currency value? Currency value increases. So this is a theoretical only, but practically sometimes what happens is if interest rate is decreased, the currency value will also decrease. If interest rate increases, currency value decreases. Nothing but interest rate and currency are inversely related. Likewise, same inflation rate also. If inflation increases, currency value decreases. And if inflation rate decreases, currency value increases. Okay. So what are the factors affecting the exchange rate? The factors affecting the exchange rate are: first one, interest rate differentials, inflation rate differentials, government policies, market expectations, investment opportunities and speculations. government policies, market expectation, investment opportunities, and speculations. For example, the dollar value is increasing, yes or no? Why the dollar value is increasing? Why the dollar value is increasing? Because it is the most popular currency in the world. It is the most popular currency in the world. So that's why what dollar prominence is. Dollar is dominating the foreign exchange market. So that's why in BRICS summit, recently in BRICS summit, Russia and India, China, so South Africa, these countries, Brazil. So these countries wanted to bring a new currency like euro. They wanted to bring one new currency to decrease the dominance of a dollar in the forex market. So that's why what Trump is levying tariff. Trump is levying tariffs on Indian exports. The reason is what? First reason. So because in BRICS they have decided to bring what? New currency. That is one of the reason. That is one of the reason. Okay. So government policies will affect what? Exchange rate. Market expectations will affect exchange rate. Investment opportunities will also affect what? Now, is it okay? Sound? Investment opportunities will also affect what? Exchange rate, and also speculations, and also what? Speculations. So now tariff, after Donald Trump came to power, okay, so lot of speculations that will affect exchange rate. And the main reason you have to know why the dollar is becoming strong and rupee is becoming weak day by day. Okay, for every batch, what is happening? For every batch, whenever I teach Forex, I will show the dollar rate. So what is happening? The dollar rate is increasing and rupee value is decreasing. So one of the main reason is what? Import of oil. Import of oil, that is the main reason. And second reason, import of a gold. Import of a gold. So we import oil, that is the main reason. We have to make a payment in dollars. We have to make payment in dollars. And to make payment in dollars, we need to purchase dollar. The dollar demand is increasing and rupee demand is decreasing. Okay. So that is the reason. And our imports are greater than exports. Our imports are greater than what? Exports. Even though we are leading in pharmaceutical exports, the ingredients for pharmaceutical products are being imported from the other country. That is the main problem. Okay. So that is the main problem. Import of oil is impacting the rupee, and also import of a gold. Import of a gold. At least we should not buy gold. At least we should not buy gold. So gold is affecting the dollar rate. Okay. And also foreign goods. We are extremely relying on what? Foreign goods. Yes or no? Because I'm using Apple tab. I'm using MacBook. Okay. Everybody purchasing what? iPhone. Of course, this contribution to the rupee is, dollar is less when compared to the oil imports. Okay. Why the oil imports are increasing? Instead of using the public transport, we are using what? Private vehicles. Everybody is having a car. Okay. Bike. So that is the reason. So that is the reason. And purchasing foreign goods. We are all purchasing what? Foreign goods. Okay. iPhone latest model is out of stock. Right now it is out of the stock. The reason, everybody what? Crazy about iPhone and they have bought iPhones. Okay. So that is the reason. So overnight we cannot increase the rupee value. Overnight we cannot. Okay. Swadeshi movement should come. Okay. Over a period, long term, it has to be long run. Okay. And next, these are the reasons for determinants, exchange rate fluctuations. So now comes the basics in Forex. With this basics in Forex, you can answer one MCQ. One MCQ. So basics is very important in Forex. If you are strong in basics, advanced concepts you will be easily can understand. Okay. So what is this exchange rate? Exchange rate means what? Price of one currency quoted in terms of another currency. Price of one currency quoted in terms of another currency. Okay. Price of one currency quoted in terms of another currency. Generally, foreign exchange quotes are two-way quotes expressed as bid rate and offer rate. Bid rate and offer rate. Now comes the problematic concept. The concept which we want for solving the questions. Bid rate means the rate at which the dealer is willing to buy. Ask rate means the rate at which the dealer is willing to sell. The dealer is willing to sell. Okay. So let me give an example. Let me give an example. For suppose $1 is equal to 74.75. $1 is equal to rupees 74.75. $1 is equal to rupees 74.75. In this, 74 is called as bid rate. 75 is called as ask rate. Bid rate means nothing but buying rate. And next, ask rate means is called as selling rate. Ask rate means what? Selling rate. Okay? Clear? So can you please tell me, for suppose if you want to go to US, what is the currency you require? You require dollar. Yes or no? So that means you have to buy dollar or sell dollar. You have to buy dollar. Tell me which rate is applicable. If you want to buy dollar, buying rate 74. For suppose, let us assume Raju, he went to US, he purchased $1 for rupees 74. That means his outflow is equal to 74. He gone to US and on same day he worked in petrol bunk and came back, and he is having $1. If he wants to sell $1, what is the amount he is going to receive? 75. So this is exactly opposite answer. Why it is opposite? You are buying $1 at 74 and selling dollar at 75 means you are getting 1 rupee profit without doing anything. Why a customer will get profit of a 1 rupee without doing anything? So these are the buying rates and selling rates, no doubt. But these are the buying rates and selling rates for the bank, not for the customer. Not for the customer. So here the questions gets complicated. First we should start the thinking from customer. What the customer is going to do. Customer is going to buy or sell. If a customer is going to buy the dollar, then what? Bank has to sell the dollar. So the relevant rate is ask rate. So first, which currency customer wants, you have to see what the customer is doing. Customer is buying or selling the currency. If a customer is buying the currency, then what? Bank has to sell the currency. So the relevant rate is what? Ask rate. That means nothing but if a customer wants to buy dollar, the rate applicable is 75. If a customer wants to sell the dollar, applicable rate is 74. So generally, ask rate will be given on the right side. Bid rate will be given on the left side. Generally, most of the cases, 99% cases, ask rate will be given on the right side. But in MCQ, sometimes what they will do is, they will give reverse. They will give reverse. So that's why we cannot say right side rate is ask rate. Simple common sense, whoever do a business, they will be buying at a lower rate and selling at a higher rate. Otherwise, there is no point of doing business, yes or no? So that's why dealer will always sell at a higher rate. Ask rate will always be greater than bid rate. The difference between the ask rate and bid rate is called as what? Spread. The difference between ask rate and bid rate is called as spread, profit. It is called as what? Profit. Am I clear? Are you getting my point? Okay. So direct quote. So here bid rate. What is this bid rate? Bid rate means it is the rate at which dealer is willing to buy. Offer rate or ask rate means it is a rate at which dealer is willing to sell. Dealer is willing to sell. Spread. How do we find out the spread? Spread is equal to ask rate minus bid rate. Difference between the ask rate and bid rate is called as what? Spread. How do we calculate spread percentage? Spread percentage is equal to ask minus bid divided by bid. Or else you can take ask minus bid divided by ask. Everybody, is it clear? Ask minus bid divided by bid or ask minus bid divided by ask. Next we have a concept of direct quote and indirect quote. Direct quote and indirect quote. What is direct quote? Direct quote means quote. Direct quote means quote is given per unit of foreign currency. If a quote is given for 1 unit of a foreign currency, then it is called as a direct quote. Indirect quote means the price of 1 unit of home currency. Price of 1 unit of a home currency. Sir, what is this direct quote and indirect quote? Direct quote and indirect quote. Simple. I will show you the exchange rates. What is the dollar rate here? $1 rate is equal to 88.67 Indian rupee. So this is a direct quote for India. It is a direct quote for India. Why it is called as a direct quote for India? Because the reason is quote is given per unit of a foreign currency. For India, which is the foreign currency? For India, US dollar is a foreign currency. And quote is also given for $1. $1 is equal to how many rupees? $1 is equal to how many rupees? For us it is direct quote. But whereas for US it is indirect quote. Because for US it is indirect quote. Because the reason is for US the quote is given per unit of home currency. Per unit of home currency. Clear? Are you getting my point? Now tell me, dollar to JPY. No, Sahil, they will not be asking any theory question. They will be asking a practical question only. Okay, but whatever I am discussing, that is the theory which is relevant for practical questions. So 1 US dollar is equal to 149.51 Japanese yen. Most of the people will be thinking like that, only exchange rate is a determinant to decide whether country is growing or not. Only exchange rate is not a sole determining factor to know whether the country is developing or not. If you see the Japanese currency value is even less than what rupee value. That doesn't mean Japanese is what? Japan is, okay, underdeveloped country. We cannot say like that. Okay. So here, okay, US currency, 1 US dollar is equal to 149.51 Japanese yen. Clear? So now tell me, for which country it is a direct quote and for which country it is an indirect quote? Everybody please tell me. Okay. For Japan, it is a direct quote. Because for Japan, US dollar is a foreign currency. Quote is given per unit of foreign currency for Japan. So that's why for Japan it is direct quote. What about for US? For US it is an indirect quote. For US it is an indirect quote. Yes or no? Everybody, is it clear? Everybody. Raju, good afternoon. Everybody, is it clear? Another Raju. Raju Boss Gaming. Clear? Everybody, is it clear? Are you able to understand the direct quote and indirect quote? Direct quote and indirect quote. Next, rupee to dollar. Rupee to what? Dollar. 1 rupee to dollar is equal to 0.011 United States dollar. 1 rupee is equal to 0.011 United States dollar. Tell me, it is indirect or direct? Think for 2-3 seconds and tell me the answer. It is direct quote or indirect quote? 1 Indian rupee is equal to 0.011 United States dollar. Is it a direct quote or an indirect quote? Okay. If a quote is given per unit of home currency, then it is called as what? Indirect quote. So for India it is indirect quote and for US it is direct quote. For US it is direct quote. Am I clear? Done. Next. Conversion of a direct quote into indirect quote. Conversion of a direct quote into indirect quote. Conversion of a direct quote into indirect quote. So this is very, very important. If you are not understanding the basics, we cannot solve advanced questions. Basics are very important. If you know the basics, then advanced concepts will be very easy. So $1 is equal to rupees 75. So tell me whether it is a direct quote or indirect quote to India. Okay. Raju Boss Gaming. Madam Sunday special ఏం చేశారు సార్? లైవ్ షెడ్యూల్ చేశారు. $1 is equal to rupees 75. $1 is equal to rupees 75. So $1 is equal to rupees 75. What is this? This is direct quote. This is what? Direct quote for India. Yes or no? Now tell me 1 rupee is equal to 1 rupee is equal to what? 1 rupee is equal to what? 1 rupee is equal to 0. Nothing but indirect quote is equal to 1 divided by direct quote. Yes or no? Sure, Raju, sure. I will make a video. Indirect quote is equal to what? 1 divided by direct quote. Yes or no? Indirect quote is equal to 1 divided by direct quote. Clear? I'm not bothered about the answer. The process of a calculation. Indirect quote is equal to 1 divided by direct quote. Am I correct? Clear? Okay. Now let us come to the next one. This is one-way quote. Yes or no? One-way quote means buying rate and selling rate are same. So whatever I have shown in Safari, these are what? One-way quotes. But whereas in practically you will find what? Two-way quotes. Okay, and in two-way quotes also spread will be 2 rupees, 3 rupees. In examination questions, the spread will be what? 1 rupee, 0.5, 0.3, 0.2. But practically what spread will be what? 2 rupees, 3 rupees, etc. Okay. Let us assume $1 is equal to Vikrant 74-75. $1 is equal to rupees 74.75. Tell me it is a direct quote or indirect quote? It is direct quote. Let us convert this direct quote into indirect quote. How to convert this direct quote into indirect quote? 1 divided by 74 hyphen 1 divided by 75. Here is the important point. Tell me the number. Here numbers matter. 1 divided by 74. 0.0 0.0135 0.133. Clear? Now, so this calculation is wrong because the reason is if you see the numbers, left hand side we got 0.0135, right hand side we got 0.0133. 0.0133 is the ask rate. 0.0135 is what? Bid rate. Ask rate can never be less than bid rate. Ask rate can never be less than bid rate. So while converting the direct quote into indirect quote, you have to be careful. So while converting, bid rate of a indirect quote is equal to what? Bid rate of indirect quote should be less. Bid rate of indirect quote should be less than the ask rate of indirect quote. Yes or no? So that's why is equal to what? 1 divided by ask rate. In denominator we should take a higher rate. Then you will get bid rate less. Yes or no? So bid rate of indirect quote is equal to 1 divided by ask rate of a direct quote. 1 divided by ask rate of a direct quote. So very good, Harshini, very good. Ask rate of indirect quote is equal to 1 divided by bid rate of a direct quote. For basics I will take time, but thereafter for every question I will be taking maximum 10 minutes time. That's it, maximum. Worst case scenario. Ask rate of indirect quote is equal to 1 divided by bid rate of a direct quote. 1 divided by bid rate of a direct quote. Clear? Nothing but forget about direct quote and indirect quote. Bid rate of one currency is equal to 1 divided by ask rate of another currency. Ask rate of one currency is equal to 1 divided by bid rate of other currency. Clear? European quote and American quote. European quote means it is quoted in amount of foreign currency per US dollar. European quote means if it is given $1 is equal to how many rupees or other currency. It is called as what? European quote. For suppose dollar is on right hand side. It is called as American quote. Nothing but Direct quote of American quote is called as American quote. Direct quote of American quote is called as American quote. Direct quote of American means what? Dollar will be coming on the right side. Clear? Next, spot exchange rate. Spot exchange rate means it is a rate paid for delivery within 2 business days after transaction place. You know that 2 days, T plus 2 days settlement. If you enter into a contract today, it will take 2 days for settlement. So spot rate means the rate applicable for now. Rate applicable for now. So 2 days is not important from examination point of view. Spot rate means rate applicable for now. Forward rate means rate applicable for the future. Rate quoted for delivery of a foreign currency at some future date. For example, 3 months forward rate. 3 months forward rate, $1 is equal to 90 rupees. 3 months forward rate, $1 is equal to 90 rupees means what? If you want to buy or sell dollar after 3 months, the rate applicable is 90. Okay? So this forward rate can be given outright. Forward rate can be given outright, or it may be given with swap points. It may be given with swap points. So spot rate, forward rate can be given outright. Forward rate, 3 months forward rate. For example, so they will give directly in the exam. In the question. In the question directly they give what? 3 months forward rate. $1 is equal to rupees 76 hyphen rupees 78. So this is outright forward rate. This is outright forward rate. That means straight away they are given a forward rate. Otherwise what? So they can give indirectly by giving a spot rate and swap points. Spot rate and swap points. Sir, what is the swap points? For example, spot rate $1 is equal to, let us assume 75.40 rupees 76.50. Spot rate $1 is equal to rupees 75.40, rupees 76.50. Next, 3 months swap points. 3 months swap points. 2030. 2030. Here we have to find out the forward rate. Forward rate is not given in the question. Forward rate is equal to $1 is equal to rupees 75.60. We cannot add directly 20. We cannot add directly 20 to 75.4. If you add directly 20 to 75.4, you will get 95.4. That is a wrong answer. Swap points. These are the swap points. These are added at the end. These are added at the end. Sometimes 4 decimals will be given. 75.5670. Then we should write 75.5690. At the end, we have to add this swap points. Clear? So, what is the ask rate? 76.80. Swap points. Here, swap points, if they are ascending, if they are in ascending order, we say that forward rate is quoted at premium. Forward rate is quoted at premium. Forward rate is quoted at premium means what? Forward rate is greater than spot rate. If a forward rate is greater than the spot rate, we say that the forward rate is quoted at premium. Forward rate is quoted at premium. So when swap points are ascending, we add. If swap points are ascending, 2030. 2030 means ascending or descending? Ascending. So that's why we added the swap points. If we add the swap points, we get forward rate. For suppose if a swap points are descending, let us assume swap points are instead of 2030, let us assume 3020 or 3010. 3010. If swap points are descending, we should not add. We should subtract. Sir, why we should subtract? I will tell you the logic. See here, what is the logic? Simple logic. I have already told you, ask rate can never be less than what? Bid rate. Ask rate can never be less than what? Bid rate. Yes or no? So 30-10, 30-10, descending. For suppose, if instead of subtracting, if I'm adding the swap points, what can happen? Ask rate can be less than what? Bid rate. Are you getting my point? When swap points are descending, instead of adding, if I subtract, what happens if I subtract? If I subtract, then what happens? The ask rate can become a lesser than what? Bid rate, which is not correct. Which is not correct. Yes or no? Clear? Okay, are you getting my point? For example, instead of 76.5, let us assume here it is 75.5. 75.5. For suppose 75.40 swap points, if I am adding, then 75.4 plus 0.3, I will get what? 75.70. What about this one? 75.60. 75.5 plus 10. So what is happening? Ask rate is less than what? Bid rate. So that's why simple logic, ask rate can never be less than bid rate. So that's why swap points, if they are ascending, add. Swap points, if they are descending, reduce. So forward rate means the rate applicable for the future. Rate applicable for the future. And if, okay, rate applicable for the future. If swap points are ascending, add. If swap points are descending, reduce from the what? Reduce from spot rate. Clear? Done. And next, forward premium. So we have already discussed forward premium. Forward premium means if a forward rate is greater than the spot rate, forward rate is greater than spot rate. If a forward rate is greater than the spot rate, then it is said to be at premium. If a forward rate is less than the spot rate, then it is said to be at discount. How do we find out the forward premium or a discount? Forward premium or a discount percentage. They will ask MCQ. How do we find out the forward premium or a discount percentage? Simple, forward premium or a percentage. Forward premium or a discount percentage is equal to difference between the forward rate and spot rate. Yes or no? Difference between the forward rate and spot rate itself is what? Premium or discount. If it is positive, premium. If it is negative, discount. So forward premium or discount is equal to forward rate minus spot rate divided by spot rate into 12 divided by n. Why 12 divided by n? We are annualizing it. In mutual funds we have discussed, right? To annualize, what we do is into 12 divided by n. For suppose if it is 3 months forward contract, we should multiply with what? 12 divided by 3. Clear? If it is positive, premium. If it is negative, what? Discount. And the most important here, cross rate. Cross rate. Okay. Cross rate. So I will explain this cross rate concept, everything with MCQs. So I'm using this bullet MCQs to explain the concept, Forex basics. Okay. And you will get 2 marks MCQ also from this. Okay. So let me explain the concept of a cross rate and conversion of a direct quote into indirect quote. Conversion of a direct quote into indirect quote. Zainab, right now faculties are focusing on exam oriented batches. So direct access, SPM BV and CFR. So after completion of exam oriented classes, revision, maybe it's okay, revision series will start. Okay. For SFM, I have already completed exam oriented batch, so that's why I'm conducting revision series. Clear? Next, you are a Forex dealer in India. You are a Forex dealer in India. The rate of a rupee and pound in the international market are US dollar 0.0138695 and US dollar 1.3181401 respectively. what will be your direct quote of pound to your customer? Okay. Once again, you will not be able to solve this question. Let me explain, okay? Because I have not explained the cost rate concept. With this MCQ, I will be explaining the cost rate. So what is given? Rates of a rupee. What is given? Rates of a rupee and a pound in the international market. Rate of a rupee and pound are given. Rate of a rupee and a pound. Nothing but the quote given is 1 rupee is equal to how many dollars? And 1 pound is equal to how many dollars? Yes or no? Are you able to understand this? So tell me, what are the quotes given here? The quotes given is 1 rupee is equal to 0.013 86,952. Yes or no? Everybody are able to understand. Next, what is the next quote given? 1 pound is equal to 1.3181401 dollar. Clear? So these are the quotes given in the question. Yes or no? Everybody is clear? Are you able to understand? Now what they are asking? They are asking you to find out what will be your direct quote of. You are a Forex dealer in India. You are a Forex dealer in India. Forex dealer in India means, what is your direct quote? The quote must be given per unit of foreign currency. So what will be your direct quote of a pound? Nothing but they are asking you to find out the quote per pound. You are in India. You are in India means what is your currency? Indian rupee. So that is nothing but they are asking you to find out the quote per pound against rupees. Okay. First here 1 rupee is equal to 0.01386,952 dollar. First we should write it as rupee by dollar. For convenience purpose, for calculation purpose, I will write dollar by rupee. I'm sorry. Dollar by rupee. If I write dollar by rupee throughout the Forex chapter, if I write dollar by rupee, what is the meaning of this? 1 rupee is equal to how many dollars? For suppose if I write rupee by dollar, so what is the meaning of this? $1 is equal to how many rupees? Okay, if I write a pound divided by dollar, what is the meaning of this? $1 is equal to how many pounds? If I write dollar by pound, what is the meaning of this? 1 pound is equal to how many dollars? Clear? So this is very important. Every time in every question we write like this. So I am writing dollar by rupee because the quote is given. 1 rupee is equal to how many dollars? So that's why. So dollar by rupee is equal to 0.01386,952 dollar. Clear? So tell me what is the second one. Second one I should write as. Everybody please tell me. Second one, how I should write? Second one I should write dollar by pound. What is the dollar by pound? 1.3181401 dollar. Clear? But what actually they are asking, that also you have to write. What they are asking? They are asking what they are asking. They are asking you to find out direct quote of a pound to your customer. You are a Forex dealer in India. Your customer is an Indian. So that means they are asking you to find out the quote per pound against rupees. Quote per pound against rupees. That means what they are asking? Pound by rupee or rupee by pound? So they are asking 1 pound is equal to how many rupees? That means they are asking. So now we are going to find out the cross rate. Cross rate means nothing but the rate which we find out using a common currency. Here we do not have a quote between rupee and pound. But what is the common currency? Dollar is the common currency. So we have a quote between dollar and rupee, and we have a quote between dollar and pound. Which is a common currency? Dollar. Clear? Are you getting my point? Okay, so rupee by pound. Rupee by pound is equal to. Okay, so what should I take? So if I multiply both, for suppose if I multiply directly both, okay, please follow me, do not calculate. So if you multiply both, then you will get what? Dollar square divided by rupee into pound. If you multiply dollar by rupee into dollar by pound, you will get what? Dollar by rupee into dollar by pound, you will get what? Dollar square divided by rupee into pound. Okay, meaningless answer. You will get meaningless answer. Yes or no? So for me, dollar should get cancelled. And I want rupee in the numerator. I want rupee in the numerator. So I'm writing in a different color. I want rupee in a numerator. That means first one, I have to change. I want to quote for rupee by dollar. Okay. Into second one, I need not change because I want pound in the denominator. Pound in the denominator. So that's why I should not change. I will take as it is. That means what? Dollar by pound. Clearer? So here I am writing it detailedly. Rupee by pound is equal to. So rupee by dollar is equal to rupee by dollar. I have a dollar by rupee, but I want rupee by dollar. How do I get rupee by dollar? 1 divided by dollar by rupee. 1 divided by dollar by rupee. Yes or no? Chaitya, you're done with lectures, both groups, but revision is completely pending. Will you be able to clear December 25 both groups? Yes, you will be able to clear. Okay. There are many students who have not completed classes yet, but still they are hoping to get rank in both groups. Okay. You need not worry. Okay, 100% you will be able to clear. Go ahead. Okay, for SFM, go through the revision series. Okay, comment, share, and subscribe. Next, see this one, rupee by dollar. So whether I have a rupee by dollar in the question or not, no. How do I get rupee by dollar? Rupee by dollar is equal to 1 divided by dollar by rupee. Yes or no? Into dollar by pound. Clearer? Nothing but what is the calculation? 1 divided by 0.0138692 into 1.3181401. So answer is 95.0386. This question, if you want me to take next 5 minutes also, I am willing to take, because without understanding this question, we cannot go further. This is not like derivatives. This is not like portfolio management. Okay. In derivatives, without futures, you can understand what options. But it is not that case. You have to understand how to find out the cross rate. How to find out the cross rate. Everybody, is it clear? If you are clear, if you are able to understand this question, I will go on to the next MCQ. So, okay, I'm not explaining MCQs here. With MCQs, with the help of MCQs, I'm explaining the concepts, basics, Forex basics. Everybody, please tell me, is it clear? If you understood the answer, I will move on to the next question. So clear? Next, come to the question number 2. Question number 2. BLC Limited, a valued customer in import business, is in need to remit euro 1 million to his European exporter. One more time, please explain. Okay. In the question, what is given? Dollar by rupee is given, right? Dollar by rupee. And the dollar by pound is given. So, but they are asking you to find out the quote between rupee and pound. They clearly asked you to find out what? Quote of a pound. Quote of a pound to your customer. Where are you? You are in India. Your customer will be an Indian, right? So that means they are asking you to find out what rupee by pound. To get rupee by pound, can I multiply these two directly? If I multiply these two directly, I will get what? Dollar square divided by rupee by pound. One meaningless number. So what actually I require? I require rupee by pound. To get rupee by pound, I should write an equation. I should form an equation. I must ensure that the common currency should get cancelled. Common currency should get cancelled, and rupee should be on in the numerator and pound should be in the denominator. So that's why what I am doing is I want rupee in the numerator. So that's why first one, instead of taking dollar by rupee, I am taking rupee by dollar into what? Dollar by pound. Second one I need not change. Why second one need not be changed? Because the reason is I want pound in the denominator. Only first one I have to change. So now if I change the first one, what is happening? Dollar and dollar is getting cancelled and I will be left with what? Rupee by pound. Okay. But here for me rupee by dollar is not given. Quote. What is the quote given? Dollar by rupee is given. So that's why dollar by rupee. How do I get dollar by rupee by dollar? 1 divided by 0.013869552. We have already seen. So quote of one currency is equal to quote of one currency is equal to 1 divided by quote of another currency. Yes or no? So 1 divided by 0.013686952 into second one I need not change. Yes or no? I want dollar by pound and dollar by pound is given in the question. So that's why 1.3181401. So 95.0386 is the answer. Am I clear? Done. Next. Second question. With the second question. So we are going to cover the entire points in second question. Okay, all the points. BLC Limited, all the points means with respect to basics, not advanced. BLC Limited, a valued customer engaged in import business. They are engaged in import business. Each and every word in Forex is important. Import business. Is in need to remit euro 1 million to his European exporter. They have to make a payment of 1 million euro. 1 million euro. The spot rate of rupee / US dollar is 65.47, 65.57, and that of US dollar by euro is 0.8053 / 0.8051. What rate will a banker quote? What rate will a banker quote to BLC Limited if the bank's margin is 0.5%? Bank's margin means charges collected by the bank. Okay, here also you have to apply the logic. What we have to do the margin. If it is ask rate, bank will add the margin. Ask rate means the selling rate to the bank. What the bank will do is, bank will add the margin to the ask rate and will collect the amount from customer. For suppose if it is a bid rate, buying rate, what the bank will do is, bank will reduce the margin from the bid rate and will pay the remaining amount to what? Customer. So bid rate is a buying rate to the dealer. Ask rate is a selling rate to the dealer. Clear? So the logic is margin is an income to the bank. Clear? So margin is an income to the bank. So that's why margin is added to the ask rate. Margin is reduced from the bid rate. Clear? Done. So next, second question. BLC Limited, a valued customer engaged in import business. The rates are given. What rate will the banker quote to BLC Limited? Please do understand this MCQ. If you understand this MCQ only, I will go further. Otherwise, no. Only basics. Basics are very, very important in Forex. Okay. So first, I'm writing the quote. Rupee / US dollar means that rate should be written as rupee by dollar is equal to 65.47 - 65.57. Yes or no? Clear? Clear? Sometimes they will be giving reverse also. Reverse means rupee by dollar, they will give 0.013, 0.014. Rupee by dollar, 0.013, 0.014. That means $1 is equal to 0.013 rupee. So there you have to apply common sense. $1 cannot be 0.013 rupee. That means what? They are given reverse. Sometimes in question they will give reverse also. You have to be careful. Especially what you should know little things, common sense things. Dollar value is greater than rupee value. Pound value is greater than dollar value. At least you should remember these two. Sometimes in question they will be giving reverse. Okay. So next quote. What is the next quote? Dollar by euro. So dollar by euro is also written. Now come to the customer. So customer is an importer. Customer is an importer. So customer importer means he has to pay euro. He has to pay euro. That means customer will buy euro. Customer will be buying euro. Yes or no? Customer will be buying euro. Customer buy euro means what? Banker will sell euro. Banker will be selling euro. Yes or no? Okay. Now what they are asking, what rate will a banker quote to BLC Limited? Banker has to sell euro. Banker has to sell euro means what? What do we require? We require ask rate. We require what? Ask rate of a euro against which currency? They have not mentioned. They have not mentioned means what? Against Indian rupee. We assume that the business is in India. Okay. So the ask rate of a euro against what? Rupee. Ask rate of a rupee. Ask rate of a euro against rupee. That means what do we require? We require rupee by euro. We require rupee by euro. That to what? Ask rate. We require what? Ask rate. Clear? Am I clear? So nothing but I want rupee by euro. What is available for me? Rupee by dollar is there. And also what? Dollar by euro. So that means I can directly multiply. I can directly multiply. Okay. What do I want? I want ask rate. I want ask rate. So that's why 65.57 into 0.8057. So 52.83 is the, okay, 52.83. What is this 52.83? 52.83 is 1 euro is equal to how many rupees? But this is not the final answer because we have a margin. What is the margin? 0.5%. Margin, we should add or reduce? We should add the margin. So 52.83 plus 0.5%. The answer is 53.09. Am I clear? Everybody able to understand this MCQ? So are you able to understand the cross rates? Fine. Next, the third MCQ. So I'm not explaining MCQs. Once again, I'm making it clear. I'm explaining concepts with the help of MCQs, and after completion of these MCQs, I'm going to start descriptive questions. Clear? So from the following quotes of a bank, determine the rate at which N can be purchased with rupees. At the rate at which N can be purchased with rupees. So tell me what they are asking. Determine the rate at which N can be purchased with rupees. So what they are asking? They want quote per N. So they want rupee divided by N. So what is given? Rupee by pound. Two-way quote is given. Next, pound by, okay, dollar. Next, dollar by N. So they have given what? A dollar by 100 Ns. Dollar by what? 100 Ns. Clear? So what I actually require? I require rupee by N. So I want rupee in the numerator. So that's why I will take rupee by pound as it is. Rupee by pound as it is. Okay, I don't want pound. So that means pound should get cancelled. So that's why I will take second one also as it is. First one as it is, second one as it is. Third one also as it is, because I want n in the denominator. So multiply all. Multiply what? All. Okay. So multiply all and clear. Here what they are asking, determine the rate at which n can be purchased. N can be purchased. N can be purchased. So n can be purchased means for us we purchase, that means bank will sell. So that's why what ask rate 75.33 into 1.565. These numbers we should take at the end. Right hand side, these numbers we should take at the end. 75.33, 1.565, 1.052. So what is the answer? 124.35. So here ask rate is not completely given. They are given just points 33. So we should take 75.31. 75.31 is the bid rate. 75.33 is the ask rate. 1.563 is the bid rate. 1.565 is the ask rate. That points we should take at the end. 1.048 is the bid rate. 1.052 is the ask rate. So everybody, you have to listen to this class again while practicing. Because if you practice on your own, it will take time. Better you listen to this class again. Okay. This is the most frequently asked MCQ, multiple choice question. Clear? So fourth MCQ. An Indian invested US dollar 1 lakh in USA. He invested 1 lakh in USA when the US dollar is 72. The investment has appreciated by 10%. Investment appreciated by 10%. While the US dollar has become stronger by 4%. US dollar has become stronger by what? 4%. Okay. The investment return in rupees is 14.4% overall. Why sir 14.4? Simple reason. I have invested 1 lakh and my investment value appreciated by 10%. The one benefit is real return on investment. Second one is the currency has become appreciated. To explain this conceptually, I have taken an example. $1 lakh appreciated by 10%. So $1,10,000. 72 rupees dollar appreciated by 4%. That means it has become 74.88. So that means at the end you will receive 1,10,000 into 74.88. So the overall inflow will be 82,36,800 minus what is your investment at the beginning? 72 lakhs. So 82,36,800 minus 72 lakhs divided by 72 lakhs, 14.4%. Or else 10% is the return, yes or no? Okay. So this is the normal return, 10%. Your investment value has appreciated by 10%. This 10% will also be appreciated by 4%. So what is the 4% in 10%? 0.4. You will get 10.4. 10.4 plus dollar appreciation. 4. Overall 14.4. Are you getting my point? Your principal will get appreciated by what? Your principal will get appreciated by 4%. Due to dollar appreciation, your principal will get appreciated by 4. What is the real return you got? The real return you got is 10. 10 plus dollar appreciation 4. 10 plus 4, 14 plus that additional return 10% will also be appreciated by what? 4%. So that's why 14.4. Or else if you're not understanding my explanation, then what? You take this example, the content which is written here. Next, fifth one. The spot and 3 months forward rate of a US dollar in relation to rupee or rupees 75, 75.35, 74.60, 75.05 respectively. What will be the annualized forward discount with respect to ask price? With respect to ask price, they are asking you to find out what? Forward premium or a discount. So what is given actually? Spot rate is given and forward rates are given. So they are asking you to find out the forward premium or a discount. How do we get forward premium or a discount? Forward premium or a discount is equal to forward rate minus spot rate divided by spot rate into 100 into 12 divided by n. So that is what we are doing here. So 1.59% is the answer. Clear? So next questions. For next questions, we need to discuss another concept. So come to the descriptive question number 1. So this question is simple question. Okay, CMA final study material question. So this is a simple question. CA final study material question. Following are the details of a cash inflows and outflows in respect of in foreign currency denominations of MNP company, an Indian export firm which have no foreign subsidiaries. This question you have to refer, just refer, that's it. Calculate net exposure. Is any of the exposure is offsetting? Is any of the exposure offsetting? So we have a US dollar inflow and US dollar what outflow. So tell me what is the net outflow? 2 crores is a net inflow. Sorry, 2 crores is a net inflow. Spot rate is given, forward rate is given. Forward rate is greater than or less than? Forward rate is greater than spot rate. Forward rate is greater than spot rate, and the dollar value is, sorry, we have a inflow. We have a inflow and forward rate is greater than spot rate. That means we get a benefit or a loss? We get a benefit. What is the benefit we are going to get? 2 crores into 0.81, that is equal to 162 lakhs. 162 lakhs. Simple question. They are asking you to find out the net exposure. So this is not a conceptual question. You just refer this question. Next, 2 crores minus 80 lakhs. Okay, 1.2 crores is the net inflow. Again, here also forward rate is greater than spot rate. Okay, so 1.2 crores into 0.61. So this is the net exposure. Next, 3 crores minus 2 crores, 1 crore. 1 crore into 75.98 minus 75.57. Again, inflow. Net exposure what? Inflow. Yes or no? Japanese and 1 lakh 50, sorry, 1 crore 50 minus 2 crore 50. What is the balance? Minus 1 crore. Nothing but net outflow. Here we have a net outflow 1 crore. Spot rate 3.2, forward rate 2.4. Luckily here forward rate is less than spot rate. We have a outflow. And the forward rate is also less than what? Spot rate. Again inflow. Again we get what? Inflow. 1 crore into 0.8. Clear? 1 crore into 0.8, 80 lakhs. So second part of the question is any of the exposure offsetting? Is any of the exposure offsetting? The exposure of a Japanese yen position is being offset by a better forward rate. This answer is given in CA final study material, but in CMA final study material, all the currencies are being offset. The exposure of all the currencies is being offset by a better forward rate, because in all the cases we are getting inflow. CMA final answer, all the exposure of all the currencies is being offset by the better forward rate. Why? Because first case inflow, first case we have an inflow and the forward rate is greater than spot rate. Second case inflow, forward rate is greater than spot rate. Third case inflow, forward rate is greater than spot rate. Last case outflow and forward rate is less than spot rate. So in all the cases we got net exposure positive. So that's why the answer given in CMA final study material is the exposure of all the currencies is being offset by a better forward rate. But in CA final they have given only what? Japanese yen, because it is outflow and forward rate is less than what? Spot rate. So this question is not a conceptual question. It's okay. You have to refer this question. Now come to the question number 2, dealer question. Question number 2, dealer question. Question number 2. Dealer question, dealer, Forex dealer question. You are Forex dealer of your bank. You are a Forex dealer of your bank. Are informed that your bank has sold a TT on a Copenhagen for Danish kroner 10 lakhs at the rate of 1 Danish kroner 6.515. First sentence, you have to understand the first sentence. You are a Forex dealer. You are a Forex dealer of your bank. Informed that your bank has sold, TT means telegraphic transfer, on a Copenhagen for Danish kroner 10 lakhs at the rate of 1 Danish kroner 6.5150. What is the meaning of this sentence? Your bank has sold 10 lakh Danish kroner, 1 Danish kroner at the rate of rupees 6.5150. This is the original transaction. So dealer has sold DKK, Danish kroner, DKK at the rate of what? 6.5150. Clear? You are required to cover the transaction either in London or New York market. You have to cover the transaction either in London or next option, New York market. The rates on that date are as under. The rates on that date are as under. Bit rate and ask rate both are given. Mumbai, London is given. Mumbai, London means quote between rupee and pound is given. Rupee is 74.3, 74.32. Mumbai, New York means rupee and dollar. New York is in US, right? London, Copenhagen, that means DKK and Copenhagen currency DKK, Danish kroner. Saurav Gupta, this PDF has been shared in Telegram group. London, Copenhagen, DKK divided by what? Pound. Copenhagen currency DKK, London currency pound. Next, New York, Copenhagen. New York, Copenhagen. In which market will you cover the transaction? London or New York? And what will be the exchange profit or a loss on the transaction? Ignore brokerages. I'm starting the answer. So help me out to solve this question. Question number 2. Question number 2. First, tell me the given codes. Given codes. Rupee by pound is given. Tell me the code. 70, 74.3 hyphen 74.32. Next code. Next, rupee by dollar is given. See the amount, rupees are given. 40, 49.25, 49.2625. Now the time is 3:39. By 3:45 we should complete this question. 6 minutes. Okay. So tell me fast. Next. Next, what is given? Pound by? No. That is DKK by pound. See, the number is given DKK and number. So what is? You should not go by the name. So what is given? DKK by pound. What is the rate? 11.42. 11.435. What is next? DKK by dollar. DKK by dollar 7.567 hyphen 7.584. These are the codes given. Now the question is where you want to cover the transaction. Where? What is this cover transaction? You are the dealer. This is a dealer question. You are the dealer. You dealer sold DKK at the rate of what? 6 point. You are the dealer and you have sold 1 DKK at the rate of 6.515. rupees. So to cover the transaction means you are selling DKK. You are agreeing to sell DKK. Yes or no? Somewhere you have to buy, somewhere you have to cover the transaction. Cover the transaction means what? To honor this transaction, you have to enter into another transaction. Yes or no? Are you getting my point? So to cover, what should he do? To cover, buy DKK. That person has to buy DKK. The question is, where should he buy DKK? Against rupee. London or New York is the question. So to cover, he has to buy. That means be careful. Other dealer has to what? Other dealer. To cover, this dealer has to buy. That means other dealer has to sell. Other dealer has to sell DKK. So that means what is the relevant rate? Relevant rate. Ask rate of rupee by what? DKK. You sold DKK at the rate of rupees 6.515. Yes or no? So to cover the transaction, you want the code for DKK. So rupee by DKK. Clear? Relevant rate. Now come to which market? First market is London. See, in London market, I want rupee by DKK. Through London market. If I go through London market, what is the common currency? Pound is the common currency. I should write the equation so that the pound get cancelled. Okay, so that means I should write rupee by pound into what? Pound by DKK. Yes or no? I want DKK in the denominator. Everybody, please, are you able to understand this? Please let me know. Everybody, are you able to understand this equation? Rupee by dollar. I want ask rate, yes or no? I want ask rate of a rupee by pound. What is ask rate of a rupee by pound? So this is a good question for cross rate finding. Cross rate finding. Okay. So whether this question comes in examination or not, you will get one MCQ for sure. What is the rupee by pound? 74.32 into 1 divided by, into what? Into 1 divided by, why 1 divided by? I want a pound divided by DKK, but pound divided by DKK is not given in question. I have a DKK by pound. So 1 divided by what? I should take 11.42. So what is the rate? Huh? 11.42. I want ask rate of a pound divided by DKK. Ask rate of a pound divided by DKK is equal to 1 divided by bid rate of DKK by clear pound. So do not get confused. What is the answer? 6.507 8 9 88 means 9. Proper rounding off is very important. 6.50788 means you should take 6.5079. Clear? Now profit or loss? Profit. 10 lakhs into, we are selling 1 DKK at the rate of 6.515 and the dealer is buying 1 DKK at the rate of 6.5079. What is the gain? 7,100 rupees is the gain to the dealer. Clear? Everybody? Everybody, is it clear? Same we should do for what? Okay, New York. Okay, pause the video and you do it for New York and tell me the profit. New York. Tell me the profit if you are covering the transaction in New York market. If you are covering the transaction, tell me the profit. 4,008. So which is the best one? So New York is simple. We should take what? Rupee by dollar into dollar by DKK. So that means we should take what? 49.2625 into 1 divided by 7.567. Everybody clear? Done? Let us move on to the next question. If it is US market, what is the gain? If it is US, what is the gain? 4,824. 830, clear. Next, come to the question number 3, purchasing power parity theory. This concept was tested in June 2025. Purchasing power parity theory, interest rate parity theory. Purchasing power parity theory, interest rate parity theory. Question number 2, practice. So question number 3, purchasing power parity theory. What is this purchasing power parity? Purchasing power parity means equal. So this theory is simple. This theory says that purchasing power in US and India are same. Okay, for suppose, let us assume 1 pen in US is equal to $1. Okay, 1 pen cost is equal to $1. Okay, in India 1 pen is equal to what? 50 rupees. Okay, so what is this theory? Purchasing power parity theory. Simple. Parity means what? Equal. As per this theory, the exchange rate must be equal to $1 must be equal to rupees 50. As per this theory, $1 must be equal to rupees 50, because the reason is purchasing power both in India and US is same. Throughout the world, purchasing power is same. If 1 pen cost is $1 here, in US it should be, oh sorry, in US it is $1 and in India it is what? 50 rupees. That means as per the purchasing power parity theory, $1 must be equal to rupees 50. Clear? Likewise, for example, inflation. Inflation in US 10%. Okay, in India 5%. Let us assume inflation 10% in US and in India what is inflation? 5% is the inflation. Now tell me, okay, inflation 10% and 5%. So tell me what happens to the pen cost in US after 1 year? After 1 year, the pen cost will increase to $1.1. And in India, 50 into 1.05. Yes or no? Inflation 10% in US. That means after 1 year, so pen cost in US will be $1.1. And in India, pen cost will be 50 rupees into 1.05. So as per the purchasing power parity theory, left hand side is equal to right hand side. So that means as per purchasing power parity theory, $1 after a year, $1 after a year must be equal to 50 into 1.05 divided by 1.1. As per purchasing power parity theory, 1 year forward rate must be equal to 50 into 1.05 divided by 1.1. So the answer is 47.72. If you see the determinants of exchange rate, if inflation increases, currency value decreases. That is what happened. In our example, dollar inflation is 10%. I have taken dollar inflation 10%. So that's what happened. Dollar value has got decreased. Rupee value increased. Earlier we needed 50 rupees to buy $1. Now we need only 47.72 rupees to buy $1. Am I clear? Now here, this concept you have to focus. Okay, 50 into what? 1.05 divided by what? 1.1. What is this 50 into 1.05 divided by 1.1? 50 is what? Nothing but spot rate. Spot rate, yes or no? Into 1 plus, what is this 0.05? 0.05 is inflation rate of home currency divided by what? Inflation rate of foreign currency. So this is how we find out the theoretical forward rate. Do you remember the theoretical forward rate in derivatives? Fair future price. Likewise, here also we use the purchasing power parity theory to find out the forward rate. As per purchasing power parity theory, theoretical forward rate is equal to spot rate into 1 plus inflation rate of home currency, or you can take right side currency, divided by 1 plus inflation rate of what? Left side currency. Am I clear? Everybody, are you able to understand? Purchasing power parity theory. Purchasing power parity. Parity means what? Equal. Purchasing power in all the countries is same. This is the assumption. Based on this assumption, for suppose, as per purchasing power parity theory, here $1 must be equal to 47.72 after 1 year. For suppose if these values are not equal, then what happens? There is a scope for arbitrage. Arbitrator will identify the market imperfection. Arbitrator will compare the theoretical forward rate and actual forward rate. And if theoretical forward rate and actual forward rate are same, then there is no scope for arbitrage. But if there is a mismatch, then there is a scope for arbitrage. So we are going to see an arbitrage question also. So are you able to understand this purchasing power parity theory question? Interest rate parity theory, I am not going to explain now the entire concept, but simple. Instead of inflation rate, we take interest rate. Simple, what we do is we take what? Interest rate instead of what? Inflation rate. That means as per interest rate parity theory, 1 unit is equal to 1 unit of foreign currency is equal to spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Am I clear? Done. Now, let us come to question number 3. So what is this question number 3? This question you have to refer. 8-year laptop is 8 version laptop is priced at $461.5 at New York. $461.5 at New York. The same version laptop is priced at rupees 30,500 in New Delhi. Calculate the exchange rate in New Delhi. Simple. As per purchasing power parity, $461.5 is equal to 30,500. That means $1 is equal to 30,500 divided by 461.5. That means $1 is equal to 66.09. Clear? Are you able to understand this? Next, if over the next year, the price of a laptop increased by 8% in New Delhi. In New Delhi, it increases by 8%. That means what is the price of bag in New Delhi? 30,500 into 1 plus 8%. 32,940. Okay. And 5% in New York. 5% in New York. What is the New York price? 461.5. And what is the price after 1 year? 461.5 into 1.05. 484.58. So they are asking you to determine the price of a laptop at New Delhi and New York. The price of a laptop at New Delhi and New York. Clear? Everybody, is it clear? Done? Sharanya, you are the top fan today. Sahil, where are you? So next question. I'm moving on to the next question. For suppose if they ask you to find out the theoretical forward rate after 1 year, then what is your answer? 32940 divided by 484.58. If they ask you to find out $1 rate after 1 year, then what is the rate? 32940 divided by 484.58. Clear? Next, see the question number 4. Question number 4 is also a past examination question. After completion of question number 5, I will give you a break with work. Question number 4. Question number 4. US dollar is selling in India at rupees 55.5. US dollar is selling at rupees 55.5. That means $1 is equal to rupees 55.5. If the interest rate for 6 months borrowing in India is 10% per annum, borrowing rate in India, what is the borrowing rate in India? 10% per annum. The corresponding rate in USA is 4%. Do you expect that US dollar will be at a premium or at a discount in the Indian Forex market? Do you expect that US dollar will be at a premium or at a discount in the Indian Forex market? Simple. If interest rate increases, currency value decreases. Yes or no? If interest rate decreases, currency value increases. Here the USA currency value is 4%. USA interest rate is 4%. That means what happens? US dollar will be at a premium. No doubt in that. US dollar will be at a premium because the interest rate in US is less. Clear? So this is a theoretical concept. But practically it may be different, okay? So there is another logic also. For exam, this is the point you have to remember. Next, what will be the expected 6 months forward rate? What will be the expected 6 months forward rate for US dollar in India? So they are asking you to find out the theoretical forward rate. How do we get theoretical forward rate? Spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Yes or no? So if you are getting confused between the home currency and foreign currency, you better take what? Right side currency divided by left side currency. Because from the left, so while deriving the formula, I have taken from the left. Yes or no? $1.1 is equal to 50 into 1.05. Okay, so better you take what? Spot rate into 1 plus interest rate of right side currency divided by 1 plus interest rate of left side currency. So okay. Am I clear? So now what is the solution? 55.5 into 1 plus. Be careful. You might do a clerical mistake here. Be careful. What is the interest rate of home currency? 10%. But that is 10% per annum. They are asking you to find out 6 months forward rate. So that means we should take only 6 months rate. Clear? So 55.5 into 1 plus 0.1 into 6 by 12 divided by 1 plus 0.04 into 6 by 12. So the answer is 57.13. Next question. What will be the rate of forward premium or a discount? What will be the rate of a forward premium or a discount? So what is the rate of forward premium or a discount? Simple. Forward rate minus spot rate divided by spot rate into 100 into 12 divided by n. Here n is equal to 6. So 57.13 minus 55.5 divided by 55.5 into 100 into 12 divided by 6. So the answer is 5.87. Clear? Everybody, is it clear? Next, question number 5, arbitrage process. Arbitrage process question. So let me explain this question. Question number 5, arbitrage process. Spot rate 1 US dollar is equal to 48.0123. 180 days forward rate for 1 US dollar is equal to 48.8190. Annualized interest rate for 6 months, rupee 12%. Annualized interest rate for 6 months, US dollar 8%. Is there any arbitrage possibility? Is there any arbitrage possibility? If yes, how an arbitrator can take advantage of the situation? If he is willing to borrow rupees 40 lakhs or US dollar 83,312. So this is a purely a conceptual question. So slowly note down the solution and try to understand this question. Question number 5. Question number 5. We came up to question number 5. We have only 12 questions remaining. Question number 5. Okay. 12 questions. 12 questions into what? Each question 10 minutes. 2 hours. Mahima Singh already have solved June 25 Forex question. So I have uploaded the video. Okay, long back. You can go through that. Okay, right now, question number 5. Question number 5. So what is this question number 5? So what is given? Spot rate is given, right? So note down the spot rate. Spot rate is equal to $1 is equal to 48 point. Tell me the numbers. 0.123 rupees spot rate. Forward rate. What is this forward rate? This is actual forward rate. This is the forward rate which is available in the market. What is the forward rate available in the market? $1 is equal to 48.8190. The question is there any scope for arbitrage? To know whether there is a scope for arbitrage or not, we should compare this actual forward rate with the theoretical forward rate. Theoretical forward rate. How do I get theoretical forward rate? Theoretical forward rate is equal to spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Clear? Spot rate. What is the spot rate? 48.0123 into 1 plus. What is the home currency interest rate? 12% per annum. 0.12 into. Be careful. High clerical mistake. High chances of doing clerical mistake. How many months forward rate? 6 months. So 6 by 12 divided by 1 plus. What is the rate? 0.08 into 6 by 12. So what is the answer? $48.9356 rupees. So this is the theoretical forward rate. Theoretical forward rate $1 is equal to 48.9356. So tell me, actual forward rate is greater than or less than? Actual forward rate is 48.8190, which is less than theoretical forward rate. Clear? Actual forward rate is less than theoretical forward rate. Tell me the course of action. That means dollar is undervalued or overvalued? Dollar is undervalued in forward market. Undervalued in forward market means spot sell dollar, forward. First you have to decide the forward. Forward buy dollar. In forward market, dollar is underpriced. In forward market, dollar is underpriced means what? In forward market, dollar is underpriced. So that's why you should buy the dollar in forward market, spot market, sell the dollar. Clear? So now comes the arbitrage process. Arbitrator earns profit without taking any risk. Arbitrage process. Arbitrator always borrows money. So in the question they have mentioned whether to borrow 40 lakhs or 83,312. 83,312. They have mentioned clearly. Yes or no? So arbitrage process. Arbitrage process. What is this arbitrage process? First step is to what? Borrow money. Which currency he should borrow? In the spot market, what we should do? Dollar. sell. So generally here in arbitrage process, Forex chapter, you should borrow the currency which you are going to sell in the forward market. Sorry, spot market. Spot market. In spot market, you have to sell the dollar. If you have to sell the dollar, you want dollar, right? So that's why in spot market, what? Borrow dollar. Borrow dollar, not buy. Borrow dollar, take loan, and then sell dollar. Sell dollar. Then you will get Indian rupees. Invest this Indian rupees in India. And after 6 months, take back the investment in Indian rupees and buy the dollar. After 6 months, you have to buy the dollar. Why? You have to repay the loan taken in dollars. So I will write the answer. You will understand. First step, borrow. Amount is given. If the amount is not given in the question, we have to assume. You have to assume $1,000 or $2,000. So borrow 83,312. $2 at the rate of 8% per annum for how many months? 6 months. B. Borrow 83,312 at the rate of 8% per annum for 6 months. B part. Immediately what? Sell dollar and receive. How much amount we are going to receive? 40 lakhs into, what is the spot rate? Sorry, 83,312 into 83,312 into 48.0123. This is the amount you are going to receive. Sell dollar and receive. Here in Forex, arbitrage process means we borrow in one currency, invest in another currency to make a profit. Invest in another currency to earn a profit. So C. Sell dollar and receive rupees 40 lakhs. Yes or no? Now what you do? Invest in India rupees 40 lakhs at the rate of 10 or 12? At the rate of 12% per annum for how many months? 6 months. Invest in India at the rate of what? Rupees. Invest in India rupees 40 lakhs at the rate of 12% per annum for how many months? 6 months. Clear? So on the same day, all the three transactions will happen as on today. On the same day, he will enter into a forward contract to buy $1 at the rate of 48.8190 on the same day. In arbitrator will not take any risk. Without taking any risk, he will make a profit. So enter into a forward contract. Enter into a forward contract to buy dollar at the rate of rupees 48.8190. What is this 48.8190? Actual forward rate. Clear? Next step. So overall you will enter into 4 transactions as on today. What is the 4 transactions? First transaction, borrow money $83,312. Second, sell dollar and receive rupees 40 lakhs. And next transaction, invest rupees 40 lakhs for how many months? 6 months. On the same day, enter into a forward contract to buy $1 at the rate of rupees 48.8190. After 6 months, what happens? Realize investment. Realize investment. What is the amount you are going to get? 40 lakhs into 40 lakhs, or else 40 lakhs plus 40 lakhs into 12% into 6 by 12. Yes or no? 40 lakhs plus 40 lakhs into 12% into 6 by 12. So what is the amount you are going to get? 42 lakh 40,000 rupees. Yes or no? If you realize the investment, you will receive 42 lakh 40,000 with interest. You will get interest. F point. Okay. So by dollar, how many dollars you are going to get? 42 lakh 40,000 divided by 48.8190. We should not multiply. Be careful. Again, here you may get confused. While converting, you are converting rupees. Code is given per dollar. So that's why divide. 86,851.851.4. Repay loan. Repay loan. What is the loan amount? 83,312 plus 83,312 into 8% into 6 by 12 with interest. Yes or no? We have to repay the loan with interest. 83,312 plus 83,312 into 8% into 6 by 12. So what is the number? So what is the number? 86,644. But we have a 86,851.4. So profit is you received $86,851.4, but you are paying 86,644. The profit is 207.4. So immediately you have to practice one additional question with Canadian dollar. That question is little complicated. That means you will get confused because the reason is in that question we do not have a Indian currency. The quote is given between DM and Canadian dollar. Can you please say the question number? Tell me the question number. Tell me the question number. In question you will find Canadian dollar and DM. Canadian dollar and DM. Question, additional question number 12. Additional question number 12. So additional question number 12. Okay, in break, go through that question. Additional question number 12. Okay. Additional question number 12. Tell me the additional question number 12, starting line. Yeah. 0.665. So that question you have to practice. So there you will get lot of doubts. Please practice that question. Half an hour break. Again our class will start at 4:45. Thank you all. Okay, fine. So question number 6 is simple past examination question. Recent CA final past examination question as well. The following two-way quotes appear in the foreign exchange market. Spot rupees by US dollar 46, 46.25. 2 months forward rupees by US dollar 47 and 47.5 required. How many US dollars should a firm sell to get rupees 25 lakhs after 2 months? How many US dollars should a firm sell to get rupees 25 lakhs after 2 months? After 2 months means what is the rate applicable? Forward rate is the applicable rate. Clear? US, how many US dollar firm should sell to get rupees 25 lakhs? To get rupees 25 lakhs. To get rupees 25 lakhs means what? To get rupees 25 lakhs means customer buy rupee, bank sell rupee. That means relevant rate is ask rate of a rupee against dollar. Ask rate of a rupee against a dollar. So that means dollar by rupee. You can think from the perspective of a rupee or else from the perspective of a dollar. Okay. So buy rupee means what? Nothing but buy rupee means sell dollar. If you are selling dollar, bank has to buy dollar. So the relevant rate is bid rate of a dollar. If it is rupee, ask rate of a rupee. If it is dollar, bid rate of a dollar. See the question. Firm buy rupee, bank sell rupee. So the relevant rate is ask rate of a rupee. But in the question, ask rate of a rupee is not given. So how can we get it? 1 divided by bid rate of a dollar. Very good. So 25 lakhs into 1 divided by what? 47. So these are the dollars we need to sell. How many dollars we should sell? 53,191.48. Simple question. Next, how many rupees is the firm required to pay to obtain US dollar 2 lakhs in the spot market? In the spot market, they have wanted to buy 2 lakh dollar. So that means customer buy dollar, bank sell dollar. Okay, so relevant rate is ask rate of a dollar. What is the present ask rate of a dollar? 46.25. Multiply. So 2 lakhs into 46.25. So how many rupees we need to spend? 92 lakh 50,000. Next, third question. Assume the firm has US dollar 69,000 in current account. Assume firm has 69,000 US dollar in current account earning no interest. In current account, you will not get any interest, yes or no? Return on investment on rupee investment is 10% per annum. Should the firm encash the US dollar now or 2 months later? If you invest in rupee, you will get return on investment 10% per annum. 10% per annum. Clear? So simple. Encash now or 2 months later. For suppose if you are encashing now, what is the balance you have in current account? $69,000. So $69,000 you sell dollar. You sell dollar, bank will buy dollar. So that means per dollar you will receive 46. Overall amount is 31,74,000. So this 31,74,000, this 31,74,000 you will be investing for how many periods? 2 months. 31,74,000 into 10% into 2 by 12. Clear? So 52,900 is the interest, and with interest you will be getting 32,26,900 if you are encashing now. For suppose if you are not encashing now, you are encashing after 2 months. So then what? You will not get any interest. You will get directly what? 69,000 into 47. 32,43,000. Clear? Past exam question. You will, in 2 descriptive questions, you will get 1 basic question. Okay. Question number 7 is also a past examination question. Z Limited importing goods worth US dollar 2 million requires 90 days to make the payment. The overseas supplier has offered a 60 days interest-free credit. 60 days interest-free credit period, and for additional credit for 30 days, an interest of 8% per annum. Z Limited is importing goods worth US dollar 2 million. US dollar 2 million. 2 million means 20 lakhs. Requires 90 days to make the payment. How many days? 90 days. So first it is 60 days, no interest. For additional credit 30 days, what is interest? 8% per annum. 8% per annum. The bankers of Z Limited offer a 30-day loan at 10% per annum, and their code for foreign exchange is as follows. Spot 1 USD, 60 days forward rate, 90 days forward rate. You are required to evaluate the following options. Pay the supplier in 60 days or pay after 90 days. Avail the supplier's offer of 90 days credit. Clear? Supplier is asking you to make a payment after 90 days. First 60 days, no interest. 30 days, he is charging 8% per annum interest. Okay, this is the first option. So second option what? Instead of taking 90 days credit, you make a payment at the end of a 60 days. If you want to make the payment at the end of a 60 days, you have to take a loan in local bank for how many days? 30 days. So one thing, either take loan either in India or what with a supplier for how many days? 30 days. For 60 days, okay. No, not required. Why? Because for 60 days, no interest. For 60 days, no interest. First, pay the supplier in 60 days. For suppose if you are paying the supplier in 60 days, so 20 lakhs into 57.1 is the outflow. So that is 11 lakh 42,000. To make a payment after 60 days, you have to take a loan in local bank at the rate of 10%. So you have to make a payment of interest for how many days? 30 days. So 11 crore 42 lakhs into 10% into 30 divided by 365. 9,38,630. So what is your total outflow? 11 crore 51 lakh 38,630 is the total outflow. Clear? Am I clear? Next, pay the supplier in how many days? 90 days. Pay the supplier in how many days? 90 days. If you are making a payment in supplier in 90 days, then what? You have to make payment of interest to the supplier. So 20 lakhs into 8% into 30 divided by 365. 13,150. Overall, 20 lakh 13,150 into what is the 90 days forward rate? 57.5. So this is the outflow. So this is a past examination question, simple question for 7 marks. 8th question you can understand on your own. 9th question also you can understand on your own. So please go through the 8th question and 9th question later on. Now let us see the question number 10. Let us see the question number 10. Sun Limited is planning to import. Sun Limited is planning to import. This question you have to practice. Remaining all questions which we discussed in this session. Okay, after the break. So those questions you have to refer. Question number 10. Sun Limited is planning to import equipment from Japan at a cost of 3,400 lakh N. Import equipment 3,400 lakh N. The company may avail loan at 18% per annum with quarterly resets with which it can import the equipment. The company may avail loans at 18% per annum with quarterly resets. Quarterly resets means quarterly compounding, with which it can import the equipment. The company also has an offer from Osaka branch of an Indian-based bank extending credit of 180 days at the rate 2% per annum against opening of an irrevocable letter of credit. Present exchange rate. What is the present exchange rate? Rupees 100 is equal to 340 N. 180 days forward rate. Rupees 100 is equal to 345 N. Commission charges for letter of credit at the rate of 2% per 12 months. Advise the company whether the offer from foreign branch should be accepted. Okay. So this question you have to practice. The company may avail loan at 18% per annum with quarterly resets with which it can import the equipment. With quarterly resets. Quarterly resets means what? Quarterly compounding. So question number 10. Question number 10. So question number 10. Okay. So option number 1. So what is the option number 1? Taking loan in India. Go through the question again. First sentence, see the first sentence. The company may avail loan at 18% per annum with quarterly resets with which it can import the equipment. Clear? Okay. So taking loan in India. What is option number 2? Taking the loan from Osaka branch. Taking loan from Osaka branch. Am I clear? So now, so what is the exposure? Exposure is equal to 3,400 lakh N. Exposure is equal to 3,400 lakh N. Am I clear? Exposure is equal to 3,400 lakh N. Done. Okay. So now what is the exchange rate? Present exchange rate. Present exchange rate 340 rupees. 340 N. 340 N per 100 rupees. So one is taking the loan in India and making the payment immediately. Clear? So tell me what is the loan amount? Loan amount will be 3,400 lakh N divided by 340 into what? 100 rupees. Yes or no? For 340 N we need 100 rupees. That means for 3,400 lakh N, how many rupees we want? We want how many rupees? 1,000 lakh rupees. Add interest first quarter. Quarterly resets means quarterly compounding. So 1,000 lakhs into, what is the rate? 1,000 lakhs into 18% into how many months? 3 by 12. Quarterly resets. You will get 45 lakhs. So 1045 lakhs. And next what? Add interest. Second quarter. 1,000 lakhs into, 1,045. Second quarter, what is the interest for second quarter? 1045 lakhs will be the principal for second quarter. 1045 into 18% into 3 by 12. 47.025. 47.025 lakhs. That means 1092.025 lakhs. So this will be the outflow under first option. This is taking from loan from India and making a payment. What is the second option? Option number 2. Osaka branch. Osaka branch is in Japan. You're taking loan from Osaka branch. You're taking loan from Osaka branch means you will be taking loan in Japanese yen. You will be taking loan in Japanese yen. So loan is equal to 3,400 lakh N plus interest. What is the interest? 3,400 lakhs into 3,400 lakhs into 2% per annum means for 6 months what is the interest rate? 1%. 1%. 2% is per annum, right? So 3,400 lakhs into 1%. So the answer is 34 lakh N. So 34 lakh N. So 3434 lakhs N is the payment. Clear? So overall loan amount with interest to be paid is 3434 lakh N. But we should convert this Japanese yen into Indian rupees. So overall rupee outflow, we should find out the rupee outflow. What is the exchange rate? 6 months forward exchange rate? 345. That means 3434 lakhs divided by 345 into 100. 3434 lakhs divided by 345 into 100. So answer is 995 lakh. 995.36 lakh. Okay, clear? But here one special point is there. One special point, letter of a credit. Letter of a credit is similar to a bank guarantee. Japanese yen bank will give a loan. No doubt. Osaka branch will give a loan, but on payment of a letter of a credit charges. LC charges. Okay, nothing but it is like a guarantee. Because we are in India and we are taking loan from Japan. Unless the branch in India gives a guarantee to the Japan branch, the branch will not give a loan. So this branch will give guarantee if you pay LC charges. Okay, so letter of a creditor. So this is the special point in this chart. Special point in this question. What is the loan? Loan is equal to 3,400 lakh N. So LC charges is equal to per annum 2% per annum LC charges. But we are taking loan for 6 months. So 34 lakh N will be the LC charges. 34 lakh N will be the LC charges. LC charges is equal to 34 lakh N. So tell me, when should we pay this 34 lakh N? We should pay this 34 lakh N as on today. If you pay 34 lakh N LC charges as on today, you will get loan 3,400 lakh N. So this is a special point in this question. So to pay this 34 lakh N LC charges as on today, you have to take loan in India as on today. Then how can you pay this 34 lakh N LC charges? You have to take loan for payment of this 34 lakh L. Original loan is being taken in Japanese N, no doubt. But for LC charges payment 34 lakh N, you have to take loan in India. Clear? Loan for LC charges. Loan for LC charges is equal to 34 lakhs divided by 340 into 100. That is equal to what? 10 lakhs. Clear? So for this we need to add first quarter interest. If you are taking loan in India, you have to pay interest quarterly. First quarter interest. What is the first quarter interest? 10 lakhs into 18% into 3 by 12. You will get 0.45. So 10.45. And for this 10.45 we should add second quarter interest. 10.45 into 18% into 3 by 12. 0.47. So overall 10.92 lakhs. So what is the outflow on LC charges? Outflow on LC charges is equal to 10.92. So we should add outflow on LC charges 10.92 to this 995.36. That means overall outflow 1006.28 lakhs. Clear? So in this question, what is the special point? LC charges. Okay. So I'm giving 5 minutes time. Go through this solution and also what previous two questions. What are the previous two questions? 8 and 9. 5 minutes time. Now 5-6 up to 5-11. Sharanya, what? Better not to go with Forex transaction. So which is the best option? Taking loan in India or taking loan in Japanese N? For question number 10. For question number 10, it is better to what? Take loan in Japanese N. So clear? Now come to the 11th question. 11th question is also a past exam question. So we are moving on to the hedging concept. Hedging. So hedging means what? Reducing the risk. So already the questions which we have discussed, the past 4 or 5 questions are also relating to hedging. Hedging means what? Reducing the risk. Hedging means what? Reducing the risk. Okay. So what is reducing the risk? How can we reduce the risk? So for mitigation of a foreign exchange risk, we have a concepts like first concept, forward contract. We already know the forward contract. We have seen the forward contract in what? Derivatives chapter. Forward contract means what? Contract entered today for the purchase or sale of a currency at a future date. So in all the previous questions we have seen the forward rate, yes or no? So forward contract. If you enter into forward contract as on today, what happens? you can ascertain the certainty in cash inflows or a cash outflows. Your cash inflows or cash outflows will be fixed. Okay. Leading and lagging. Leading means making a prior payment. Instead of waiting, make a payment in prior. Okay. Lagging means delay. Okay. So leading and lagging. By leading and lagging also we can reduce the risk. And one more thing is billing in home currency. That is the best one. Billing in home currency. If you're making a billing in home currency, then what? There is no foreign currency risk. For example, for BCCA, no foreign currency risk, because even if a student from Dubai wanted to purchase CMA final class, he has to pay in Indian currency. Okay, student who is working in Dubai from India, okay, that person. So question number 11. Question number 11. And we have advanced concepts like money market hedging, currency futures and currency options. We are going to discuss only 4 concepts in this class next session. I mean in next 1-2 hours. So what is the session? First, forward contract, and next word money market hedging, currency futures, currency options. Leading and lagging already covered. So billing in home currency. For billing in home currency, no question is required. Practical question, yes or no? So see the question number 11. A company operating in Japan has today affected sales to Indian company. The payment being due 3 months from the date of invoice. 3 months from the date of a invoice. The invoice amount is 108 lakhs N. What is the invoice amount? 108 lakhs N. A company operating in Japan has affected sales to Indian company. That means Indian company is an importer. The payment being due 3 months from the date of invoice. The invoice amount is 108 lakhs N. At today's spot rate, it is equivalent to rupees 30 lakhs. It is anticipated that exchange rate will decline by 10% over the 3 months period in order to protect the N payments. The importer proposes to take an appropriate action in the foreign exchange market. Yes, leading. If you are making a payment in prior, then what? So you need not pay any interest. Okay. In lagging, we have to pay interest. If you're lagging, if you're making a delay payment, then you have to pay interest. The 3 months forward rate is presently quoted at 3.3 N per rupee. You are required to calculate the expected loss and to show how it can be hedged by a forward contract. You are required to calculate the expected loss and to show how it can be hedged by the forward contract. So this is a simple question. Question number 11. So right now, what is the invoice amount? 108 lakh N. 108 lakh N is the payment, right? Yes or no? So it is equivalent to 30 lakhs. It is equivalent to 30 lakhs. So tell me, what is the present exchange rate? Present exchange rate is equal to 108 lakhs divided by 30 lakhs. So present exchange rate is equal to 1 rupee is equal to 3.6 Japanese N. Now here the question is, it is anticipated that the exchange rate will decline by 10% over the 3 months period. In next 3 months period, the present exchange rate will decline by 10%. So what happens if it declines? What is the present exchange rate? 1 rupee is equal to 3.6. This 1 rupee may decrease to 3.24. If 1 rupee decreases to 3.24 N, that means what is happening? The rupee is getting weakened. If rupee gets weakened, what happens? Importer outflow will increase. Importer outflow will increase. Importer has to buy Japanese yen. And if rupee value decreases, so okay, rupee outflow will increase. So that's why in order to protect the N payments, the importer proposes to take appropriate action in the foreign exchange market. The 3 months forward rate is presently quoted as 3.3 N per rupee. So what is the present quotation? 3.3. Okay, you are required to calculate the expected loss to show how it can be hedged by the forward contract. What is the present worth of a goods? 30 lakhs. For suppose if I am not doing hedging, what is the present worth of a goods? 30 lakhs. But what is my expected outflow after 3 months if I am not going for hedging? If I'm not going for hedging, then what is my outflow? 108 lakhs divided by 3.24, 33.33 lakhs. Sir, when to multiply and when to divide? Here I'm converting rupees. Sir, I'm converting N, but quote is given in rupees. Then divide. For suppose if I am converting N and quote is also given in N, multiply. Conversion and quote both same, multiply. If a conversion and quote are different, then what? Divided by. So 3.33 lakhs is the expected loss. For suppose if I enter into a forward contract, then what is my outflow after 3 months? 108 lakhs divided by 3.3. 32.73. So 2.73 is the outflow. So by entering into a forward contract, the loss can be reduced by 0.6 lakhs. Clear? So 12th question you can refer. You will be able to understand. That is money market hedging concept, 12th question. Now I am going to explain what 13. It will take time. 13th question. So 14, 15, 16 and what 17. So these questions will take time. So total how many questions are left? 5 questions. These 5 questions, each question on an average definitely will take 20 to 25 minutes, even half an hour also. These 5 questions. Solid questions, 5 questions. You may get 1 7 marks question from these 5. Okay, approximately these 5 questions might take 2 hours time. Okay, 17th question will not take much time. So I will explain 17th question first, and later on we will be left with how many questions? 4 questions. 4 questions. With 4 questions we are going to learn 3 concepts: money market hedging, currency futures, currency option. Clear? So Hopeful Limited, an Indian MNC, is executing a plant in Nepal. They are executing a plant in Nepal. It has raised rupees 400 billion. You should know what is billion. Billion means 100 crores. Even if you know what is billion, then okay, fine. You just ignore billion. Okay, let it be in billions only. Okay. It has raised rupees 400 billion. Half of the amount will be required after 6 months time. Half is required after 6 months time. That means half is not required for next 6 months. So that means 200 billion rupees. Hopeful Limited is looking for an opportunity to invest this amount for a period of 6 months. So I say CA final past questions are very important. Why I say? Because this question was asked in May 2023 CA final. So see here, May 2023 CA final question asked in June 2023 old syllabus immediately, and later on it was asked in December 2023 new syllabus. Clear? So Hopeful Limited is looking for an opportunity to invest this amount for a period of 6 months. It is considering following 2 options. Nature of investment: UK, index fund, Europe, treasury bill. Okay. It is considering following 2 options. One is what? UK, and second is what? Europe. One is UK index fund, second is what? Europe treasury bill. So 2 options. If you are investing in UK index fund, what is the benefit you are getting? Dividend. Great Britain pound in billions is given. Income from stock lending is given. Discount on the investment value at the end. If you are investing in index fund, your investment value will decrease by 2%. Okay. But we are getting benefit of dividend and income from stock lending. Exchange rate spot is given. What is exchange rate spot? GBP/INR is equal to 0.0099. That means 1 rupee is equal to how many pounds? Exchange rate 6 months forward is given. 6 months forward rate. What is exchange rate 6 months forward? 1 rupee is equal to 0.0100 pounds. As an investment manager, advise the best option to invest. Advise the best option to invest. Best option to invest. Simple question. Okay, examination question, 7 marks question. First, suppose if you are investing in UK, you are having a surplus fund. How much surplus fund? 200 billion rupees. 200 billion rupees means first you should convert this 200 billion rupees into pounds. Quote is given for INR or pound? Quote is given for INR and you are converting INR into pounds. Conversion rupee, quote is also for rupee. So multiply or divided by? Multiply, simple. So 200 into 0.0099. 1.98. If you convert this 200 rupees into pounds, you will get 1.98 pounds. Forget about a billion for the time being. Okay. Next, dividend income is already given in pounds. What is the dividend income? 0.1369. Stock lending income is also given in pounds. 0.0007 pounds. Next, what? The value of a investment decreases by 2%. That means 1.92. So 1.98 will decrease to 1.98 will decrease to 1.9404. Clear? 1.9404 is nothing but 1.98 into 98%. Clear? So what is the overall investment value at the end? 1.9404 plus 0.0007 plus 0.1369. You should take these three numbers total. Yes or no? 1.98 is the investment at the beginning. 2% is the discount. So that means 1.98 will decrease by 2%. Decrease by 2%. That means new investment value is equal to 1.98 into 98%. So this is 1.98 into 2%. So 1.9404. So what is the total? 2.0780. So this is the investment, overall investment value at the end of 6 months. So what is the exchange rate after 6 months? After 6 months, exchange rate is 0.0100. 0.0100. So now tell me, I should convert the pounds into INR. So I am converting pounds. Quote is given for rupees. I cannot multiply. Divided by, I have to divide. 2.078 divided by 0.01. This is the realization. What is the overall realization? 207.8. Gain is equal to, what is the gain? 7.8 is the gain. Clear? Now come to the treasury bill. Treasury bill. So treasury bill, the only benefit is interest, 7.8% per annum. First we should convert this 200 into euros. What is the present euro rate? 1 rupee is equal to 0.011 euros. 200 into 0.011, 2.2. So 2.2. So what is interest amount? 2.2 into 7.8% into 6 by 12. 0.0858 overall. 2.58. So 2.2858. So this 2.2858 should be converted into 2.2858 should be converted into what? This 2.2858 should be converted into INR divided by 0.011. 207.8. So what is the gain again? 7.8. Okay. So both the investment opportunities giving the same gain. Then where to invest? It is better to invest in treasury bills. Why? Because no risk. Without risk, we can earn 7.8 profit. Index fund is risky. So that's why it is better to invest in what? Treasury bills. Clear? So next we are left with how many questions? 4 questions. So these 4 questions are very important. Money market hedging. Question number 13. First read the question. Pause the video and read the question for next 2 to 3 minutes or 5 minutes. Read question for 5 minutes. So let us see the money market hedging concept. Money market hedging, question number 13. After solving this question number 13, you should go for what? Question number 12. I mean, you have to practice after class. So question number 13, I'm going to explain money market hedging. So what is this money market hedging? Money market hedging means simple concept. So first of all, see the question. You as a treasury manager are required to show how the company can hedge its foreign exchange exposure using forward market. Using forward market we already know. And also what? Money market hedge, and suggest which the best hedging technique is. We have to say which is the best hedging technique. Simple. Question number 13. So understand this question. So first I will tell you the explanation. What is this money market hedging concept? First, suppose you can have a foreign currency payable or a receivable. So first I will talk about the payables. Foreign currency payable. You have a foreign currency payable. What you actually do to reduce the foreign currency risk is simple. You have to make a payment. You have to make a payment in the future, foreign currency payment. What you do is, you will be depositing present value of a future exposure in the bank as on today. For example, UK pounds, you have a payments in pounds, you have a payment in pounds. What you will do is, in UK bank, you will be depositing present value of a exposure as on today. For suppose 100 pounds is the payment after 6 months. Present value of 100 pounds is, for example, 95 pounds. What I will do is, I will be depositing 95 pounds as on today in the UK bank. So that this 95 pounds with interest will become what? 100 pounds in the future. So I will withdraw the deposit and I will make the payment of what? Supplier. I will make a payment to the supplier. Today I am depositing 95 pounds, yes or no? Today, to deposit 95 pounds, first I should buy the pound. First I should buy the pounds. To buy the pounds as on today, in India, I will borrow loan. I will borrow money. In India, if I borrow money, so today itself I will be knowing what? With interest, how much I am going to pay in the next 6 months, yes or no? So simple concept, money market hedging. Money market hedging, if it is payable, what you do is, you will be doing what? Simple, you will be, exposure is foreign currency payable. If exposure is foreign currency payable, deposit foreign currency. Deposit foreign currency. How much foreign currency you are going to deposit? You are going to deposit present value of a exposure. Clear? Not the exposure amount. You are going to deposit what? Present value of a exposure. So that this present value of exposure will become with interest equal to exposure. So what I will do is, I will withdraw the deposit and will make the payment to the supplier. But to deposit foreign currency, we have to buy it, yes or no? So that's why you have to borrow what? Home currency. Even if you have any confusion with this question, you will get clarity. For suppose if it is receivable, if I have a receivable, what I will do? I will borrow the present value of exposure. I will borrow the present value of exposure. For suppose I have 100 pounds receivable after 6 months. What I will do is, as on today, I will be borrowing 95 pounds. Clear? So if I borrow 95 pounds as on today, with interest, this will be equal to 100 pounds after 6 months. How will I repay this loan? Simple. My customer will pay 100 pounds. I will receive 100 pounds from customers and will pay the loan. Clear? So today I am getting 95 pounds. Yes or no? I am borrowing 95 pounds. What I will do is, I will convert this 95 pounds into Indian rupees and I will be depositing in India for next 6 months. So if I deposit in India, with interest, how much I am going to receive? I will be knowing, yes or no. So that's why I can reduce what? Uncertainty. Clearer? If it is receivable, suppose if it is receivable. So I have a receivable 100 pounds. Okay, listen to me carefully. I have a receivable what? 100 pounds. My customer is going to pay after how many months? 6 months. But in next 6 months, pound value may increase or decrease. So there is an uncertainty, yes or no? My objective is to reduce the uncertainty. How can I reduce this uncertainty? Through money market hedging. What is this money market hedging? Simple. I have a 100 pounds receivable after 6 months. What I will do is, I will borrow 95 pounds as on today from UK bank. Sir, how can I pay this loan? Simple. How will I pay this loan? This loan 95 pounds with interest will become 100 pounds. So I will receive 100 pounds from customers and pay off the loan in UK. Clearer? But today I am borrowing 95 pounds, right? What I will do with this 95 pounds? I will convert this 95 pounds into Indian rupees. The purpose is to reduce the risk. I cannot keep the 95 pounds in pounds itself. I will convert this 95 pounds into Indian rupees and I will invest this INR for next 6 months. If I invest INR for next 6 months, I will be knowing what? How much interest I am going to earn. I know. My cash flows are certain or uncertain? My cash flows are certain. So that's why it is called as a hedging technique. Clear? So this is simple. So I will explain with this question. Question number what? Question number what? Okay. So please help me. Exposure. So tell me the exposure. 4,80,000 pounds. Payable or receivable? Payable. How many months? Payable in 3 months. Payable in what? 3 months. Clear? Okay. Next, receivable 1,38,000 pounds receivable. In how many months? 3 months. Clear? I have a payable in 3 months, receivable in 3 months. What I can do is I can go for netting. Netting means what? Set off. So I will be doing a hedging for only the balance amount. What is the balance amount? 3 lakh pounds. Overall 3,42,000 payables or receivables? Payable. In how many months? 3 months. 3,42,000 pounds is a payable in how many months? 3 months. And again, I have a second exposure. What is the second exposure? 5,90,000 euros receivable in how many months? Pounds? Euros? Receivables in how many months? 4 months. Clear? So I'm not reading the question. Company is in US. Company is in US. For this company, pound is a foreign currency. Euro is also a foreign currency. Yes or no? So that's why they are doing hedging. Okay. First, let us consider what? Payable. So what is the payable amount? 3,42,000 pounds. 3,42,000 pounds. So clear? Okay. In this first we have a forward contract. Forward contract. So forward contract. So tell me, what is the forward rate, 3 months forward rate? So we should convert this pounds into what? Dollars. Because the company is in US. Company is in US. So be careful. What is the quote given? $1 is equal to how many pounds? Quote is given per dollar. Quote is given per dollar. So be careful. So be careful. Okay. So think very slowly. So we have a payable. What is a payable? Pound. We have a pound payable. 3,42,000 pounds. You are a customer, yes or no? You are going to buy pounds or sell? You are going to buy pounds or a sell pound. You have to buy. Payment. Payment means you have to buy. You are buying pound. That means bank has to sell pound. Yes or no? Think slowly. You have to make a payment. Pound. Customer buy, bank sell. So that means relevant rate is ask rate of a pound. Ask rate of a pound. But whereas in the question, we have a quote per dollar. Quote per dollar. So that's why what? 1 divided by bid rate. What is the bid rate? 0.9520. Clear? So that means what is outflow? Outflow is equal to 3,42,000 into 1 divided by 0.520. So answer? Mahima Singh, very good answer. 3 lakh. So 3,59,244. So 3,59,244 what? Dollars. So this is a forward contract. Am I clear? Done. Clear? What is the second one? What is the second one? Money market hedging. Money market hedging. First one, again I am telling you. See the process. Pound buy, customer buy, bank sell, relevant rate, ask rate of a pound. But ask rate of pound is not given. So that's why what? 1 divided by bid rate of a dollar. Clear? That is money market hedging. Now come to the, sorry, that is forward contract. Now come to money market hedging. First step. I have a payable or receivable. I have a payable. So to reduce the risk, what I have to do is deposit present value of a exposure. Deposit present value of exposure. Where to deposit? In UK. In UK we have to deposit. In UK we have to deposit. Sir, why we have to deposit? Because we have a payment. To honor the payment, we have to deposit as on today. For example, a married person after having kids will start depositing the money. Why? For future. In future, he will be having receivables or payables? Payables. Yes or no? So deposit present value of a exposure. See the calculation. 3,42,000. Where to deposit? UK. So see what is the deposit rate in UK? Deposit rate is always less than the lending rate. Two rates are given, yes or no? Out of two rates you have to choose only one. Which rate? Lesser one or higher one? Lesser one. 1 plus 0.1 into 3 by 12. 3 months, yes or no? Discounting, we are doing discounting. Present value, we are finding out the present value. 3,42,000 divided by 1 plus 0.1 into 3 by 12. So what is the amount? 3 lakh 3,33,658.5 dollars. Dollars. Dollars or pounds? Pounds. Deposit present value of exposure. We are depositing pounds. Clear? Now come to B part. What is the B part? So to deposit 333,658.5 pounds, we have to buy pounds, yes or no? In order to buy pounds, we should take a loan in dollars. Okay, good questions, right? You're enjoying Forex, huh? So to deposit 333,658.5 pounds, we need pounds, yes or no? That means we should buy pounds. How can we buy pounds? By borrowing money in dollars. So next, dollars to be borrowed. Dollars to be borrowed. So tell me the amount, dollars to be borrowed. Please, everybody try dollars to be borrowed. Find out the dollars to be borrowed. Very good, Bharat Reddy Karnool, UK pounds. Dollars to be borrowed. So tell me dollars to be borrowed. Dollars to be borrowed. So tell me, customer buy pounds, yes or no? That means bank sell pounds. Relevant rate, ask rate of a pound. But ask rate of pound is not given. So that's why. So 333,658.5 divided by bid rate. What is the bid rate? 9830. Very good, Nana. So to practice. So what is the number? Dollars to be borrowed. 333,658.5 divided by 0.983. 339,429 dollars. Clear? So borrowing ho gaya. Next step. We should wait for 3 months. We should wait for 3 months. After 3 months, what we do is withdraw deposit. After 3 months, this is withdraw the deposit and pay supplier 3,42,000 pounds. Yes or no? After 3 months, what I will do is I will withdraw the deposit and pay off what? 3,40,000. Forex, initially you might feel confused, but it is easy. No formula, nothing. Just logic. Withdraw deposit and pay the supplier 3,42,000 pounds. So, clear? Because I have made a deposit of 333,658.5. That amount will, with interest, will become what? 3,42,000. I will make a payment to the supplier. But whereas in India, I have taken a loan, yes or no? Sorry, in US. In US, I have taken a loan, yes or no? So outflow on payment of a loan. So outflow on payment of a loan. What is outflow on payment of a loan? What is the loan you have taken in US? In US, you have borrowed 339,429. So on this 339,429 dollars, you have to make payment of interest. What is the interest rate in US? 2 rates are given. Which rate we have to take? Highest rate, because we borrowed money. We borrowed money, so that's why we should take highest rate. Thank you, Mahima Singh. Feeling happy. 339,429 into what? 12% into 3 by 12. So what is my outflow? 3,49,612 dollar is my outflow. Clear? So tell me which is the best one, forward contract, money market hedging. Money market hedging is the best one, because under forward contract, what is my outflow? 359,244. But whereas under money market hedging, what is my outflow? 349,612. Money market hedging is simple. What we are doing is, you have to make a payment after 3 months, yes or no? Okay. But what we are doing is, we are depositing present value of a payment in foreign country as on today. So that what happens? We need not worry about the payment to the supplier, yes or no? Because we withdraw the deposit and make a payment to the supplier. But for today, to make the deposit in foreign currency, we need to borrow home currency. That is what we have done. Clear? Yeah. Yes. 333,658.5 is the pounds. We deposited 333,658.5 pounds in UK. So that will become 3,42,000 in 3 months. We withdraw the deposit and pay the supplier 3,42,000 pounds. Okay, supplier liability get closed. But whereas to make a deposit of 333,658.5 pounds as on today, we have taken a loan in US amounting to $339,429. So as on today, we took a loan. So that loan amount with interest will become what? $349,612. Clear? So that means today itself I am knowing what is my outflow after 3 months. What is my outflow after 3 months? $349,612 is my outflow after 3 months. Clear? So now come to what? Receivable. Receivable. This is a practice question. This is not a regular class, so that's why what you will find, okay, little confusing. In regular class, I used to teach Forex 2 times. I will come to question number 17, up to question number 17, again go back, and again I will come back from what? Beginning. Okay. Later on I will continue from 17 to 25. But for examination purpose, 17 questions enough. Okay. Receivable. First forward contract. First what? Forward contract. Receivable means inflow or outflow? Inflow. So we have a euro receivable. What is the amount euro receivable? 5,90,000 euros. So tell me, this 5,90,000 euro, customer sell euro, bank buy euro. That means relevant rate is bid rate of a euro. So bid rate of a euro is given in the question or not? See. Bid rate is given in the question, directly given in the question. So the rate applicable is 1.9510. So that means inflow is equal to 5,90,000 into, this time we are multiplying because we are converting euros. Quote is also in euro. 1.9510. 5,90,000 into 1.9510. 11,51,000. 11,51,090 dollars. This is a forward contract. Next B, money market hedging. So B, money market hedging. So tell me money market hedging. First step is to, this time we have a receivables. So we have a receivable, so that's why what? Borrow. Present value of exposure. If I wait next 3 months, next 4 months, there is an uncertainty, yes or no? So that's why what I will do is, I will borrow as on today, the present value of exposure. How much I am going to borrow? 5,90,000 divided by euro borrowing rate. What is the euro borrowing rate? we should take highest rate. So 1 plus 0.16 into high chances of doing clerical mistake, you might take 3 by 12. But here we should take 4 by 12. Why 4 by 12? Because you have a receivable in 4 months. $5,60,000, 560, 127 euros. This time euros. Borrow present value of exposure. Next what? Okay, borrow present value of exposure. We cannot deposit directly. We should convert this euros into dollar and then deposit. Okay. Next, deposit dollars. How many dollars we can deposit? First we should calculate. We sell these euros. Customer sell euro. That means bank buy euro. Relevant rate is bid rate. So bid rate of a euro is already given. What is the bid rate of euro? So 560, 127 into 1.889. So deposit how many dollars? $10,58,000 deposit. Next, C part. What is the C step? Receive. On maturity, receive 5,90,000 euros from customer. Receive 5,90,000 euros from customer and pay supplier. Yes or no? Sorry, pay loan. Pay loan. Clear? Receive 5,90,000 euros from customer and pay loan. So this is after 4 months. Clear? So after 4 months, inflow on withdrawal of deposit is equal to, what is inflow on withdrawal of deposit? Inflow on withdrawal of a deposit 10 lakh 50,000 58,080 plus 10 lakh 58,080 into what is the deposit rate in US? Deposit rate in US. We are depositing dollars in US 11.5% into what? 4 by 12. 10,58,080 plus 10,58,080 into 11.5% into 4 by 12. So tell me what is the inflow? Inflow on withdrawal of a deposit. Inflow on withdrawal of a deposit. $10,98,640. So for receivables, which is the best one? Money market hedging or forward contract? Forward contract is the best one. For receivables, which is the best one? Forward contract is the best one. Clear? Done? Everybody, this is a money market hedging. This is a question you have to practice. Unless you practice, you may not be able to do it. So I'm giving a 2 minutes time. So okay, 5 minutes, take 5 minutes time and go through the solution. Concepts left. So one is the currency future. This is a past examination question and high chances of asking this question because last attempt they have tested options question, currency options. Derivatives we have discussed, right? You know the concept of options and futures. In futures we have a 2 positions, long position, short position. In options we have a 2 options, call option, put option. Call option and put option. Clear? So long position and short position. So when we take a long position, if we have an expectation that the price is going to increase, we take a long position. If we have an expectation that the price is going to decrease, we take a short position. Yes or no? So that we do in derivatives chapter. Here also similar only. Okay, we need not worry. But the point is here, currency future. So only one question is there in CFNL material, and so this question is being tested in CFNL as well as CMA final. This question number 14. Question number 14, December 2023, new syllabus question. Okay. Currency future. Initially, every question, every concept, you will feel confused in Forex, but you have to practice, you have to go through, you have to listen to the class again. Just listen for 10 minutes or 15 minutes, one concept, and just pause the video, go through the solution, then you will understand. So these are not that easy questions to understand just in 5 minutes or 10 minutes. Okay. So this is a currency future concept. Next concept is what? Currency futures. Okay. First tell me, so there can be exporter or importer. For exporter, there will be a receivable, yes or no? For importer, payable. Simple, apply your common sense. Exporter. Exporter will get benefited if foreign currency value decreases or increases. Exporter will get benefited. Exporter will get benefited if a foreign currency value increases. Because exporter will have a receivable. Exporter will have a receivable. So exporter always wants foreign currency to appreciate and home currency to depreciate. What about importer? Importer always expect the foreign currency to depreciate and home currency to appreciate. Okay, so clear. So importer, but generally importer will have a fear. Importer fear is what? Foreign currency may appreciate, home currency may depreciate. Likewise, exporter will have a fear. What is exporter fear? Foreign currency value might depreciate, home currency value might appreciate. In one question, so the present exchange rate is 3.6. 1 rupee is equal to 3.6 N. Okay. It is expected that 1 rupee will decrease by 10%. That means 1 rupee will be equal to what? 3.24 N. In that question, customer is an importer. Importer is worried. Why the importer is worried? Importer is worried because the rupee value is getting depreciated. Importer worry is what? Home currency depreciate. So importer worries about what? Home currency depreciation, foreign currency appreciated. Exporter will be worrying about home currency. Exporter will be worrying about what? Home currency appreciation, foreign currency depreciation. Clear? So now question number 14. EFD Limited is an export business house. EFD Limited is an export business house. The company prepares invoice in customer's currency. Company prepare invoice in customer's currency. Its debtors of US dollar 1 crore is due on April 1, 2015. So they are making payment on April 1, 2015. Market information as at January 1, 2015 is given. Market information as at January 1, 2015 is given. So that means how many months due? We are in the month of January. We are in the month of January, and the payment is to be receivable in how many months? Payment is to be receivable in how many months? 3 months. Rates are given. Exchange rate 1 rupee is equal to how many US dollars? Spot rate is given. 1 month forward rate is given. 3 months forward rate is given. So be careful here. Okay, 1 rupee is equal to, that means quote is given per rupee. Currency future. Currency future. 1 rupee is equal to 0.016519. 1 month forward. 3 months future is given 0.016118. Contract size is given in rupees. Contract size is given in rupees. Initial margin 1 month margin, 3 months margin. Interest rate in India 6.5 and 7%. On April 1, 2015, the spot US dollar / INR is 0.016136 and currency future rate is 0.016134. Which of the following methods would be most advantageous of EFD Limited? First one, forward contract. Second, using currency future. Third one, not hedging the currency risk. So do not do any hedging. Okay, do not do any hedging. So question number 14. Do not do anything. So wait for what next 3 months, whatever happens. Okay. Let put a faith on God. Okay. So question number. Question number 14. So this question is also for practice. What is the exposure? Exposure $1 crore. Exposure $1 crore. Okay. Exposure $1 crore. Next. Okay. $1 crore receivable or payable? Receivable. In examination, you need not write. In examination, you need not write. So here the exporter loves, yes or no? Or expect the dollar value to increase, rupee value to decrease, yes or no? He hates dollar getting depreciated, rupee getting appreciated. Rupee getting what? Appreciated, yes or no? So generally hedging means reducing the risk. A person who has a fear will go for what? Hedging. So that means here the exporter fear is what? Dollar value might decrease or rupee value might increase. Clear? So now, so what is the first part? First part is simple. What is the first part? Forward. Forward contract. Forward contract. So 3 months forward rate is given in the question or not? 3 months forward rate is given in the question or not? Yes, 3 months forward rate is given. 1 rupee is equal to 0.016129. Yes or no? 0.016129. So inflow is equal to, here I am converting what? Here I am converting dollars into rupees. Quote is given per rupee. I should multiply or divide? I should divide. I should divide. Or else if you have any confusion whether to multiply or divide, so better you write like this. 1 rupee is equal to 0.016129. 1 crore dollar question mark. 1 crore dollar question mark. Clear? But every time we cannot write like this right now. Yes or no? So that's why we are converting dollar, but the quote is given per rupee. So that's why what? Divide. So 1 crore divided by 0.016129. What is the number? 1 crore 62,000,1240. Nothing but 62 crores. 62 crores 1240. 62 crores 1240 is the inflow in rupees. This is a forward contract. Let us complete the last one. What is the last one? No hedging. That is easy. Though that's why let us complete what? No hedging. If you are not hedging, then what is the rate applicable? The rate applicable is the spot rate on the maturity. What is the spot rate on maturity? 0.016136. If you are not going for hedging, if you are not doing any hedging, then inflow is equal to 62 crores. Sorry, not 62 crores. 1 crore divided by 0.016136. 61 crore 97 lakh 32,275. 61 crore 97 lakh 32,276 rupees, 275 rupees. Okay. Now come to the futures. This is the special point we are going to learn in this question. Currency futures. Currency futures. This concept is what? A little complicated. Currency future. Tell me which position we should take, long position or a short position. First tell me which position we have to take. We are receiving dollar. That means we have to sell the dollar. We have to sell the dollar. So tell me which position we should take. Okay. So first thing, here the quote is given per rupee. So that's why we should think from the perspective of a rupee. We should think from the perspective of a rupee. In this question, we are going to sell dollar. That means rupee buy. In future, we are going to buy the rupee. So that means what is the long position? We should take what? Long position. We should take long position. Here the quote is given per rupee. Quote is given per rupee. So that's why we should think from the perspective of a rupee. You might be thinking like, sir, I am receiving dollar. I have to sell dollar. So that's why the position we have to take is short position. No. Here the quote is given per rupee. So that's why we should think from the perspective of a rupee. This is one way of a thinking. The other way of a thinking is, here the exporter is worried about what? Exporter is worried about what? The rupee value might increase. Quote is given per rupee. Okay, if he is worried about the increase of a rupee, then he has to take what? Long position for rupee. Long position for rupee. So long position at the rate of, so what is the 3 months future rate? So long position at the rate of 1 rupee is equal to 0.016118 dollar. Today I will be taking a long position. Today I will be taking a long position at the rate of 1 rupee is equal to 0.016118 dollar. Today. Clear? To close this long position contract, I will take on maturity, to close this long position contract, I have to take short position. So tell me what is the future rate on maturity? Future rate on maturity is given 0.016134. So you are buying at 0.016118 and you are selling at 0.016134. Clear? So profit Buying at a lower rate, selling at a higher rate. $0.000016. Good question. This is good question. You will take time to understand, but easy if you know the logic. Because I will not refer any concept before coming to the class because I understood the logic, so that's why. So this is the gain. Huh? First two parts. With the first two parts, you can score 3 marks. And for futures, you will get 4 marks. But this is also easy. Do not worry, okay? Long position at the rate of rupee. To close the contract, we should take what? Short position. What is the gain? $0.000016. That is the profit per rupee. Profit per rupee. So here, one more complicated point is coming. Number of contracts. We should find out the number of contracts. Number of contracts. Contract size is given. First of all, what is the exposure we are covering? The exposure we are covering is 1 crore. We are covering the exposure $1 crore. So we have to find out the number of contracts. How do we get number of contracts? Divided by the contract size. But the contract size is in rupees. So that's why we should convert these dollars into rupees. What is the future rate we agreed? 0.016118 dollar. All divided by 2 crore. 2 crore. What is the contract size? 2 crore 48 lakh. 16,975. So number of contracts. How many contracts? 25 contracts. So this is also a special point in this question, finding out the number of contracts. I cannot divide the exposure directly with contract size. Why I cannot divide the exposure with contract size? Because exposure is in dollars. Okay, contract size is in rupees. So that's why. Next, let us find out what inflow. Inflow. Okay. Inflow, first take variation margin, or we can call it as profit or a loss on closure of future contract. Profit or a loss on closure of a futures contract. So tell me how many contracts. Please do understand this calculation. This is very important calculation in this question. If you understand this calculation, that means you know the currency futures. How many contracts? 25 contracts. What is the contract size? 2 crore 48 lakh 16,975. 25 contracts into 2 crore 48 lakh 16,975 into what is the gain per rupee? For 1 rupee, you got a profit of 0.0066. You got a profit of $0.000016. 25 into 2 crore 48 lakh 16,975 into what is the profit per rupee? Profit per rupee is equal to $0.000016. But the entire profit is coming in dollars. The entire profit is coming in dollars. We calculate profit on the maturity. Entire profit we are getting in dollars, but we want in rupees. We should convert this profit in dollars into rupees. So that's why divided by $0.016136. What is the 0.016136? 0.016136 is nothing but what? Spot rate on maturity. Everybody please do understand this concept. Variation margin. I'm getting profit of $0.000016 for 1 rupee. Total how many contracts I have entered? 25 contracts. And what is the contract size? 2 crore 48 lakh, 16,975. I'm converting entire profit in dollars into what? INR. So what is the amount? 6,15,195 rupees. On closure of futures contract, you are getting a profit. On closure of futures contract, you are getting a profit of 6,15,195. Next. What is the next one? Inflow on sale of $1 crore. You are selling $1 crore, yes or no? If you sell $1 crore, how much you will receive on the maturity? 1 crore divided by 0.016136. We have closed the futures contract. What is the next step? We sell the $1 crore in the market on the maturity. How much we are going to receive? 61 crore, 97 lakh, 32,276. Clear? So one more point here is important point. Interest on initial margin. We have to reduce interest on initial margin. So what is interest on initial margin? Total 25 contracts. Initial margin 22,500. 22,500 is the initial margin for one contract. 25 contracts into 22,500 into what is the interest rate? 7% into how many months? 4 months or 3 months? 3 months. So 25 contracts into 22,500 into 7% into 3 by 12. That is equal to 9843. This we have to reduce because interest on initial margin is outflow. Sir, what is this interest on initial margin? Simple. Initial margin is a security deposit. If you want to enter into a futures contract, you have to make a deposit. After 3 months, you will get it back. But for the next 3 months, what you are losing? You are losing interest. So that's why reducing. So what is the final answer? 6,15,195 plus 61 crore 97 lakh 32,276 minus 9843. This is the net inflow under currency futures. 62 crores 3 lakhs 37,627. 62 crores 3 lakh 37,627. So tell me which is the best option? Which is the best option? Futures is the best option. Futures option would be most advantageous as the inflow is the highest. 5 minutes, go through the solution. I'm pausing the video. Pause the video and go through the solution. Everybody please go through the solution. Currency options. I will explain question number 15. Question number 15. This is a past examination CMA final question as well as CA final question. Okay. So you might have already drained out, but this is the concept, very important. Currency options, question number 15. Okay. Please focus on this question as well. Students, please do listen to the currency future concept again. Please come again, okay, from the beginning. Question number 15. An American firm is under obligation to pay interest of Canadian dollar 10,10,000 and Canadian dollar 7,05,000 on 31st July and 30th September respectively. So we have a payments, two payments. So last two attempts they have asked options from Forex. Last two attempts. So less chance, but we cannot take a chance. That's why. The firm is risk averse and its policy is to hedge the risk involved in all foreign currency transactions. They have wanted to hedge all the risk. The finance manager of the firm is thinking of hedging the risk considering two methods, fixed forward or option contract. The finance manager is thinking of hedging the risk considering two methods, fixed contract or option contract, fixed forward or option contract. Two methods. They want to consider what? Two methods, fixed forward or option contracts. It is now June 30. Following quotations regarding rates of exchange, US dollar per Canadian dollar from the firm's bank were obtained. Regarding rates of exchange, what are the rates? US dollar per Canadian dollar from the banks were obtained. Spot rate is given, 1 month forward rate is given, and 3 months forward rate is also given. An American firm has to pay interest 10,10,000 Canadian dollar, 7,05,000 Canadian dollar. American firm, US firm, US currency dollar, but payment is to be made in Canadian dollars. Quotes are given per Canadian dollar. So here this table is little clumsy, not in our material, in exam also. You have to understand this part. First time you will not be able to read this question also. Price for a Canadian dollar / US dollar option. Price of a option on a US stock exchange are as follows. What is given in brackets? Cents per Canadian dollar, payable on purchase of the option, contract size Canadian dollar 50,000. We know that futures and options are standardized. So we have a contract size. What is the contract size of a Canadian dollar? 50,000. That means here strike price is given per Canadian dollar. Strike price is given per Canadian dollar. Cents per Canadian dollar. What is given here? Price for a option. Price for a option is given. So this is the strike price. These are the prices of option. These are the prices of a option. So what is the strike price? 0.93. What is this 0.93? For 1 Canadian dollar is equal to, if 1 Canadian dollar is equal to $0.93, then these are the premiums applicable. These are the premiums applicable. Clearer? For suppose if strike price is 0.94, then these are the premiums applicable. If strike price is 0.95, then these are the premiums applicable. Clear? According to the suggestion of finance manager, if options are to be used, 1 month option should be bought at a strike price of 94 cents. There are 3 strike prices, yes or no? 0.93, 0.94, 0.95. So finance manager is of the opinion that if he wants to go for 1 month option, he wants a strike price of what? 0.94. And 3 months option at a strike price of 0.95. And for a remainder uncovered by the options, the firm would bear the risk itself. For the remainder uncovered, if anything is uncovered, so we have to bear the risk. For this, it would use forward rate. For this, it would use forward rate as the best estimate of a spot. Transaction costs are ignored. Recommend which of the above two methods would be more appropriate for the American firm to hedge its foreign exchange risk on the two interest payments. So I'm starting explaining the solution, but you have to pause the video. When you watch again, you have to pause the video, read the question again, and then start listening to the solution. So question number 15. Question number 15. So what is this question number 15? There are two payments, yes or no? First payment 10,10,000 Canadian dollar in how many months? In 1 month. Payment 10,10,000 Canadian dollar in 1 month. Clear? Okay. In this first one, forward contract. Forward contract. Forward contract. Outflow is equal to. Okay. So 10,10,000 Canadian dollar. We have to buy the Canadian dollar. Yes or no? After 1 month, one way quote is given. Quote is given per dollar and we have to convert the Canadian dollar. So that's why multiply 10,10,000 into 0. 0. What? 0.9301. This will be the outflow. What is the outflow? $9,39,401. Now come to second part. What is the second part? Options. Yes, it is a CA exam question as well as CMA final exam question. CMA final examination question. This question was tested in the past. Now come to options. First, decide which option is relevant, call option or a put option. Tell me what is the relevant option. You know that call option means right to buy, put option means right to sell. I have to make a payment of Canadian dollar. I have to make a payment of Canadian dollar. That means Canadian dollar buy. Strike price is also given for Canadian dollar. Strike price is also given for Canadian dollar. So that means what? Okay, so the relevant option is call option. I have to buy Canadian dollar. Strike price is given for Canadian dollar. You should think from the perspective of a strike price. The strike price is given for Canadian dollar. So that's why what? You should think from the perspective of a Canadian dollar. What you are going to do with Canadian dollar? So I'm going to what? Buy the Canadian dollar. So that's why relevant option is call option. In futures and options, in currency futures and currency options, please do note this point. In futures and options, you should think from the perspective of the quote. Quote. Here the strike price is given per Canadian dollar. So that's why we are thinking from the perspective of a Canadian dollar. So which option is relevant here? Call option is relevant. Clear? Yeah. You are an American firm. Strike price is given for Canadian dollar. So you have to buy Canadian dollar. So the relevant option is call option. For suppose if in this question, strike price is given per dollar, then the relevant option is put option. Because to buy Canadian dollar, you have to sell dollar. So the relevant option is put option. Clear? So relevant option, call option. Now come to number of contracts. 10,10,000 divided by, what is the contract size? 50,000. So how many contracts? 20 contracts. 20 contracts. Clear? So uncovered. What is uncovered here? You might have got 20.2. So uncovered is equal to 50,000 into 20 minus 10,10,000. 10,000 Canadian dollars are uncovered. 10,000 Canadian dollars are uncovered. Yes or no? Now, outflow on 20 contracts. Outflow on 20 contracts. What is outflow on 20 contracts? 20 contracts into, what is the contract size? 50,000 Canadian dollars. So what is the strike price we are choosing for 1 month? 94. So 0.94. What is the meaning of this 0.94? 0.94 strike price. I have a right to buy 1 Canadian dollar at the rate of 0.94. So one thing here you have to remember, this is not an exact outflow. It is a maximum outflow. Because on the maturity, if the Canadian dollar price is less than 0.94, I will buy in the market at a lesser price. My outflow will be even more less. Yes or no? So that's why here in this question, we are not finding out the exact outflow under options. We are finding out what? Maximum outflow. So 20 into 50,000 into 0.94. 9 lakh 50, 9 lakh 40,000. Next, outflow on uncovered. What is outflow on uncovered? I have a 10,000 Canadian dollar which is uncovered under options. For that I use a forward rate. What is the forward rate? 0.9301. So answer is 9301. And I have to take call option premium. So what is the call option premium? Call option premium. 20 contracts, 50,000 into C in the question. What is the premium applicable? 1 month. 1 month and strike price is 0.94. So what is the premium applicable? Premium applicable is equal to 1.02 cents. 1.02 cents means we should take 0.0102. 0.0102. So the answer is 10,200. So what is the overall outflow? What is the overall outflow? $9,59,501. So tell me which is the best one? Forward or options? So which is the best one? Forward is the best one. 939,401. Clear? In the same way, we have to do for what? 3 months. What is the payment? 7 lakh 5,000 after 3 months. For after 3 months, what is the strike price applicable? After 3 months means strike price applicable 0.95. What is the premium? For 0.95, what is the premium applicable? 1.64 cents. That means you should take 0.0164. So second part you have to do. What is the next payment? 7,05,000 Canadian dollar in 3 months. Please everybody do. Second part, everybody please solve it. Everybody please do it for next second part. 7,05,000 which is payable in next 3 months. Tell me the outflow under options and forward. Yeah. So clear everybody? So under forward, what is the answer? Under forward, what is the answer? 6,59,598 dollar. What about options? 6,81,000. For second part, what is the answer? Forward 6,59,598 dollar. And for options, what is the answer? 6,58,000. Sorry, 6,81,158. So which is the best one again here also? Which is the best one? Forward contract. Clear? Next question, go through the question and answer, you will understand, okay? So, okay, options frequently in last attempt they have asked. Go through that question. Okay, Forex you have to focus up to this what? Question number 17. Question number 17. If you have a time, then go up to what question 25, question number 25, that I have already explained in previous marathon. In previous marathon, I have explained up to 25, question number 25. But my suggestion is what you just stick to what 17 if you're writing both. Everybody please respond. Please respond. You might be feeling a little confused. The solution is what? Please listen to the class again. That is the only solution. And you have to practice questions. You have to practice question. Okay. So with this we have completed what? Forex revision. Please, anybody please let me know. So tomorrow we do not have any class. Please do watch the previous classes and this class again. Focus on these questions, and I will be giving a list of questions which are most important for exam. Nothing but the same questions which we have practiced in class. Only those questions. I might add 4 or 5 questions to this list, and I will be giving a super 50 questions. Okay. In next week, within a week, I will be giving what super 50 and also bullet MCQs. So super 50 and bullet MCQs are the same. Okay, same, clear. But there might be a small change in the list. That's it. So please do not wait for super 50 or a bullet MCQs. I have already covered the questions which are important from the examination point of view. Mahima Singh, thank you so much. Thank you. Everybody please do respond. Remaining students, please do respond. So on priority, my sincere request to you is today, please go through the next options question and also what Forex, all the questions which we have discussed in this revision session. Please go through these questions, okay? Sharanya. So you will get compulsory what 1 MCQ 2 marks and 2 descriptive questions. Till now they have been testing 2 7 marks questions up to options only. So after options we have another concept. Okay, fate of a forward contract, but they are not asking questions from fate of a forward contract. Till now they haven't asked any question from fate of a forward contract. Clear? So if anybody want to ask something, please ask me because I am winding up class. And if you want anything else, please let me know. Yes, Vaishnavi, practice this question. These questions are enough. Practice these questions. These questions are enough. If required, what I will be adding it to Super 50. You need not worry. But concepts wise, we have covered all the concepts in Forex. Even if there are 1 or 2 questions, you will be able to understand. Okay? Clear? Vaishnavi, till now what? Whether you understood currency future and currency option or not? Yeah, question. You have to read the question. You have to read the question. First you have to understand the question. Understand the question. So question reading is very important. And once again the point is, in currency futures and currency options, we should think from the perspective of a quote. If a quote is given per dollar, you should think from the perspective of a dollar. And if a quote is given per Canadian dollar, you should think from the perspective of a Canadian dollar. Okay? Clear? So students who have registered for test series, they will have an exam tomorrow, SFM exam. Or SPMBV, I think yesterday SPMBV exam has got completed. Okay? For online students, I think next week will be the SFM exam for online students. For face-to-face students, SFM exam will be tomorrow. But for online students, you can write either tomorrow or else what next Saturday as per the schedule. That is up to you. Okay? Clear, everybody? Everybody clear? So please do not worry about SFM. Do not worry about SFM because I will be keep on analyzing the CFNL papers and CMA SFM papers. and also each and every MCQ I will be giving best for December 25 attempt. You need not worry. So do not expect any other class. If possible, I will record marathon, but so marathon and all is not required because everything is covered in revision series. So mostly I will be giving a list of questions and MCQs. You practice those list of questions and MCQs. So that is enough. And regular class students, you need not expect anything because everything is covered in regular class, and in our book, all are covered. Nothing else is required. Okay? Clear? So thank you. Thank you so much. So patience is very important. So one thing you have to observe in this class, first day around 110 students came to live. Okay, with an intention to watch classes for 5 days. But after 1 hour or 2 hours, the number has got reduced to 60, 70, and later on the number has got reduced to 40 first day. So day by day the number has got decreased. This is the main problem with CMA students and also with CA students. Okay, so they will not be carrying the energy throughout the revision period or throughout the exam preparation period. So they will not carry the same energy levels till the examination. So be careful till examination. Until you complete examination, you have to carry the same energy level. You have to sit for long hours. You have to study effectively. So I hope, you found this revision series effective because we sat for continuously 4 to 5 hours, sometimes 6 hours also. 6 hours, effectively 6 hours without wasting even a single minute time. Yes or no? So in first day, I haven't given break for much time. But afterwards, I gave a break. But otherwise, effectively we prepared for the last 5 days. This kind of a preparation is required to clear CMA final examination. Okay. And students, you might be feeling bored or feeling drained just for 4 hours or 5 hours class. Earlier, I used to take class from morning 6 to evening 6 live class continuously for 12 hours without even giving a break. Okay. So if you are preparing effectively, 5 days more than enough for SFM preparation. 5 days more than enough. If you are preparing effectively daily 12 hours a day, 5 days more than enough. Okay. You have to pick the correct question. So what are the questions I have picked in Forex? All are solid questions, not just Forex. In all the chapters, all are solid questions. Clear? Okay. And give me suggestions on any other videos which I have to make on YouTube, like recalling the formulas. Like Bhavya ma'am is doing 7 marks in 7 minutes. Likewise, if you want anything from SFM, okay, portfolio management, all formulas in 5 minutes or 10 minutes, I will do it. Okay, derivatives or Forex, whatever. Okay, but I think for law it may work out, but for SFM it may not work out. Okay. Mahima, if you are writing both groups, my suggestion is next month. What is the next month? October, right? Okay, October. See, in October month, you have to study for, if you are writing both groups, at least 10 hours. 10 hours. Even 8 hours is also enough. 8 hours is also fine. Effective hours. I'm talking about effective hours. Some people will sit, okay, and sitting before the book and they will be having daydreams. So that is not considered as effective study. So I'm talking about effective study. Effective study means, for example, last 4 or 5 hours is effective. Yes or no? Likewise, you have to study 10 hours, October. And November, up to November 15, 8 hours to 10 hours is more than enough, even for group 3 or both groups. But after November 15, till the completion of examinations, daily 16 hours. Daily 16 hours is required. Last month is very important. How can we study for 16 hours daily? So you have to be in the trance. You should not use the phone. Okay, you should not be in contact with anybody, and you have to study for 16 hours. That 16 hours includes what? Break time, okay, while eating or something, while doing something else also. You have to be in the trance. That is very important. So students who are writing both groups especially, last month is very important. Last month, generally what students will do is, results will be announced on August 10th or 11th. So on 11th, after seeing the result, they will be feeling like, this time I should get the rank. This time I will show you ICMA what I am. So they will start effective preparation from August 11th. And by September 30 or 20, they will get rained out, and what? They will be, okay, not studying at all. So that is not correct. We should always take our preparation to increasing trend. We should take our preparation in increasing trend, okay? Preparation has to be in an increasing mode. Clear? So we also, for example, we work hard up to December. So after December, what we do is, next January and February, we simply sitting and we will be waiting for results. Because on February 10th or 11th, your results will be announced. We will be waiting for results. Okay? And we will be feeling happy on February 10th or 11th because we receive lots of messages. Okay, lots of voice notes that we have cleared both single, okay, or I have secured rank. Likewise, we will receive messages. And after February results, again we will be working hard in April and May. So always we should take our preparation in an increasing trend. So keep this in your mind. Keep this in your mind. So whether you waste time in October 1 or 2 days, that is not at all matter. But in November, especially from November 15th, you should not waste your time. Okay? Clear? So if you have any other issues, please let me know in Telegram group, paper 14. So we have our Telegram groups for all the subjects, all 8 subjects. You can join those Telegram groups for doubts, clarification and all. Clear? Thank you all. Thank you so much. Thank you. Meet you in felicitation at the rate Nujvidu. Meet you in felicitation program with your parents. Okay, please attend felicitation program with your parents. Okay, so parents will feel proud, yes or no, Vishnu? Okay, they will be feeling proud. For you, this may not be, I mean, felicitation may be a small thing for you, but for parents, what, it is a memorable thing. So that's why what, please do attend. Thank you, Harshini. Thank you. Thank you so much. Thank you all.